All right, so good morning. Good morning.
Morning to you, sir.
Right, so yeah, thank you very much. A bit of lateness by a few minutes. I think all the same, lost to continue, yeah? Yeah, so we've been in class for a very extended time, and I'm thinking that we will do the first 2.5 hours, and of course, break very shortly, and then resume for another 2 hours, yeah? Now, first of all, I hope you have seen the handout, the Excel which I've sent, because that is what I'll be using for this area on financial reporting and analysis. I will be updating that Excel with one more question. I think tomorrow, one thing that is missing in that Excel is still, yeah? Otherwise, everything else is part of that Excel of this application area. Yeah? So just one more question, and then that Excel will be complete. So let me send the additional question tomorrow. So there's something on consolidation which I've not included in that Excel, yeah? So I'll be doing that earliest possible by tomorrow, yeah? So otherwise for today, we can then introduce and of course be able to look at, I'm planning on looking at about 3 areas today. and financial reporting and analysis. And of course, for that reason, allow me to begin by really discussing what is the content that we should cover under now this area. The content under financial reporting and analysis shall include, number one, I will be discussing analysis. I will be discussing analysis of financial statements, the analysis of financial statements, the analysis of financial statements, and then number two, I will be discussing cash flow, the cash flow statement, which is normally International Accounting Standard number 7. Thirdly, I will be discussing the published. I will be discussing the published financial statements, which is normally International Accounting Standard number 1. Number 4, I'll be discussing financial statements forecasting. Financial statements forecasting, which has no accounting standard. Number 5, I'll be discussing the consolidated financial statements. This is normally governed by 2 accounting standards, the International Accounting Standard number 10, and then the International Financial Reporting Standard number 3. And then in general, we should discuss number 6, the preparation of what I can call the basic financial statements, but which largely I will cover under the published, because the published financial statements also discusses how you prepare financial statements of companies. And so I'm saying I may not expressly discuss this number 6, but of course, number 3 will then illustrate how you prepare financial statements specifically for companies. But in general, your syllabus reads as we should know how to prepare financial statements generally. So this number 6, I will more or less cover it under that number 3. Without much on this content, allow me to start on number 1. And this is about financial statements analysis. Financial statements analysis. And so when I talk of analyzing financial statements, what am I referring to? Who has an idea of what analyzing financial statements mean? What is to analyze financial statements? Anybody? Yes? Yeah, very simply, this involves breaking down. This involves breaking down financial statements. This involves breaking down financial statements. Let me say that into information. So into information, more useful for decision making. So into information, more useful for decision making. Yeah. So ladies and gentlemen, financial statements are normally very general, and a lot of times, especially for non-accountants, they may not make a lot of sense. And so the further breakdown of such financial statements into information that is more refined, more useful for decision making, that's what we carry out under the analysis of financial reports. And we do have that. Analysis can be done. So analysis of financial statements can be done using which are the tools which we can use to analyze financial reports. The first one, we can use what we call the common size. We can use what we call the common size financial. We can use what we call the common size financial statements. And then secondly, this you have come across before, we can also use ratios. So the tools which you use to analyze financial reports, majorly we have two. Of course, we have many others. But the ones which your syllabus has specified and directly mentions are these two: the common size financial reports, and then secondly, we have ratios. All right, so we shall then proceed to delve into each of these reports, or rather each of the tools, starting with this which we are calling the common size. The common size financial. The common size financial reports or financial statements. So when I talk about the common size reports, again, I want to believe that you have come across this also. And what kind of financial reports are these ones? How do they look like? So that who remembers? How do the common size financial reports look like? Do we have somebody, anybody remembering?
Maybe a trail.
Yes, go ahead. And who is this?
Okay, it's Meshak. I think these are the financial statement of position and statement of activities.
Okay. Now, they are not very different from what we know, yeah? Actually, they are the normal financial reports. Only that additionally, we present what I would call a percentage point for each and every item in that financial report. So I'll do the normal financial report first. Commonly, we have the income statement and then the balance sheet. So I'll do them normally as we do financial reports, but additionally, I'll present also what we call a percentage point for each and every line item in the report. And this percentage point, we do calculate based on what I call a common base now for that report. And very shortly, we shall be seeing what I mean. So let's just comment that the normal financial reports are the normal financial statements presented together with a percentage point, for each and every line item, in the report, in the report. I will continue that to calculate the percentage point. We use the following common. Common basis. We use the following common basis. We use the following common basis so that I will have a column for financial statement. I will have a column for a financial statement. And then I'll talk of we have base. So the first financial statement, we can have the income. Statement. And then secondly, we have the balance sheet. The base for the income statement is normally the sales revenue figure. And then the base for the balance sheet, we have the total assets. The base for the balance sheet, we have the total assets. And what I mean by this basis is simple. If you want to calculate the percentage point For the line items, like now for the income statement, you will express each of the items as a percentage as a proportion of the sales revenue. And when you are in the balance sheet, of course, each of the items will express as a proportion of what? The total assets figure. Worry less, because very shortly we are showing what I mean by these things. Now, before we can show what I mean by these things, let me just conclude that the common size financial statements are also important in a comparison. As below. So as below. Number one, they can be used to compare. Two or more entities. So two or more entities to determine which is better. They can be used to compare two or more entities to determine which entity you then consider better. Number two, they can also be used to compare two or more. They can be used to compare two or more accounting periods for the same entity. Say to determine in which period performance is what? Better, yeah? So say to determine in which period performance is considered what? Considered better. So majorly, we use them for comparison. You can compare two or more entities to determine which of the two or more do you consider better, or for the same entity, you can use them to compare two or more accounting periods. In which case, you want to determine in which period performance is then considered what? Now better. All right. Let's proceed on to look at the illustration to this. And let's look at sheet number 2. Let's look at sheet number 2, yeah? Number 2 in that very Excel. So down here, sheet number 2 is the one I've labeled common size financial statements. So the common size financial what? Statement. So let's look at that second sheet. So let's look at that second sheet. Kindly go through the question first. Read through the question first so that we solve it. So that question of Dragon Limited. Yeah, some of you have come across this question before. It's a question from financial reporting, intermediate. So I believe some of you have done it before. But of course, now in the context of business data analytics, let's do this in Excel, yeah? In Excel. So read the question first, then we proceed on to solve it. All right, so the question, of course, introduces this entity. And then the second paragraph says that the following, or rather the financial statements of the two entities, as at that is the reporting date, are then as shown below. So we have statement of profit or loss for the two companies, and then followed by the statement of financial position, again for the two companies. Now, what does the questioner require? One common size statement of profit or loss, remember, for each of the two entities, followed by the common size statement of financial position. And then based on that, number 1 and 2, advise the directors of the company on the best company now for takeover. Yeah. So let's have the solution down here. Let's have the solution, and let's begin with number 1. Number 1, and number 1 wants the common size statements of profit or loss. Now, let's appreciate what. Like I've said, these are the normal financial reports. The only additional thing is that you prepare them together with a percentage point for each of the line items in the report. And we have said that to come up with the percentage point, to determine the percentage point, can you work with a common what? Base. When preparing the income statement, I've said that the common base, remember, is the sales revenue figure. What you therefore do is very simple. Can you then express each of the line items as a proportion, remember, of the sales what? Revenue. So what we'll do is I'll copy this information for the income statement. Let me start with the first company. That let me just copy that. So copy, and then I'll have it down here. So I'll copy paste. So that maybe I can rearrange this. I'll just cut and have it. I'll have it probably. Yeah, I can have it here. So paste. So that apart from this normal, this normal report, I'll have a column which I'll call %. The same thing I'll do for the second company. The same thing I'll do for the second company, which is a company 𝐂𝐳. And then, of course, similarly, I'll copy all that. And then again, I'll need a percentage column. So I'll need a percentage column. A percentage column. All right, so the same reports are what I have. The only thing I've done is to add this percentage thing. So that percentage column, remember, is what makes these reports be called the common size reports. Yeah, so that percentage column. All right, so remember what we have said, yeah, that for you to determine the percentage column, work with for the income statement, work with the sales revenue as the basis. So work with the sales revenue as the basis, and what we mean is very simple. Can you express each of those line items as a proportion of the revenue figure? Yeah, like let me start with the sales revenue itself. You know, the revenue is here. So everything in this report, you then express as a percentage. So you then express as a percentage of that revenue figure. So everything here divide by the revenue and then convert to a percent. You see, like for the revenue, I'll take this revenue figure, I'll divide by the revenue. So I'll divide by the revenue, and that gives us how much? 1. And this we need to convert to a percent, remember, so that as a percentage, that's about 100%. So a figure divided by itself is normally 100%. A figure divided by itself is normally 100%. So it's normally 100%. Is normally 100%. So that's normally 100%. So that's normally 100%. Yeah. So the same will apply to the second company, 𝐶𝐸, so that also this revenue figure divided by the same revenue, that's about still 1, which is 100%. If I go to the cost of our sales, like now this one for 𝐵O, for the first company, I'll take the cost of our sales that, I'll divide by revenue. Everything you divide by revenue and then convert to percentage, so that this one comes to about 76%. The same will apply to the second company, this 114, divide by revenue, which is 140, and that comes to about 82%. So that will continue, remember, all the way to the last item in this report, which is the profit. So continue doing that. Of course, you don't need to continue doing that one by one. For each of the items, you can lock what you should, the locking concept, and then just drag the formula downwards. Yeah. So that let me lock the revenue here. Just lock the revenue because revenue is constant, so I just lock it, and then I just drag the formula to the last item. The same I'll do here. I just lock the revenue, then I drag the formula to the last item, and so that is it. That is now what we call the common size statement of profit or what? Profit or loss. And is anybody having any question on that? That is it for the common size P&L. Nani yako na swali? Any question? Reu aturudi huko. Talk to Reu, can you talk to a classmate to help you? We are not going back there. Talk to a classmate, Reu. All right, so if there is no question, so issues like locking, please be talking to your classmates so that we don't have to be wasting time going back to very basic issues that we did almost week 2 of start of the semester. All right, so if that is the case, then let's be looking at required number 2. Required now, by the way, before I can even proceed to required number 2, yeah, I can actually answer this required number 3. Because number 3 talks about advise the directors of Dragon Limited on the best company for takeover. Yeah? When you then use these percentages, you know you can compare the two companies and determine which of the two companies is what better. When we compare the two, you know those percentages are more or less like ratios. And we know that you can use ratios to compare 2 or more companies, yeah? Which of the two companies has better percentages, better ratios here? When you compare the two, which one has better percentages? So 𝗂𝐴ble has better percentages. Is there anybody with a contrary opinion? You know, when you look at these percentages, of course, you can't use the revenue because both of them have 100%. But when you use like the cost of sales, the costs, the lower the costs, the better. And so 𝗂𝐴ble has less at 76 compared to 82. So 𝗂𝐴ble is better. When you compare gross profit, 𝗂𝐴ble has more, so 𝗂𝐴ble is better. Yeah, distribution cost, they are the same. But when you come to admin again, 𝗂𝐴ble has less, better. The operating profit, 𝗂𝐴ble has more at 19, so 𝗂𝐴ble is better. The finance cost, 𝗂𝐴ble has 1%, so 𝗂𝐴ble is better again. The profit before tax, 𝗂𝐴ble has more at 18%, so 𝗂𝐴ble is better. The income tax is the only one on which company 𝐶𝐸A is actually better, yeah? It's the only one on which 𝐶𝐸A is actually what better. Otherwise, everything else, company 𝗂𝐴ble is considered what? Considered better. So that means by and large, the best company for takeover, and we can have this answer here, yeah? That 𝗂𝐴ble Limited, the best company for takeover is therefore 𝗂𝐴ble what? 𝗂𝐴ble Limited. So that answers number 3. All right, let's look at required number 2. So required number 2, and these now ones that we prepare the common size statements of financial position of the two companies. So we have common size statements of financial position. So common size SUFP. So again, what we'll do, we'll have each of the two companies first, and then of course the percent. Yeah, so you'll start in the same manner. The two companies are then the percentages, and then the balance sheet items are these ones. So I'll just copy those. So copy, and then I'll paste it down here. Then similarly, I'll copy the figures. Okay, so what have we said is the base or the percentage for the balance sheet?
Amen. Total assets.
Yeah, the total asset figure, yeah? So the total asset figure, remember, is this item here. Let me just highlight it. Meaning that you now divide everything by this total assets figure and then convert to a percentage, yeah? So that for the first one, this is 98 divided by this 33.6. So everything you divide by 33.6. And then we convert that to percentage. The same for the second company. Yeah, so, and again, so that you drag your formula, you have to lock the total assets figure. To drag your formula, you must lock the total assets figure. So I'll just lock that. I will lock that. All right, so I just drag that to the last item down here. And the same thing for this other one. I just lock, and then I drag the item to I drag that to the last item. Of course, I need to clean this up where I don't need percentages. All right, so that's it. That is it. Yeah, so and that's it for that is it for the common size balance sheets. So that unless somebody has a question, then we are done with that illustration. The common size reports are very simple reports. They are just the normal financial reports, but then prepare them together with what we have called the percentage point. Remember, for each of the line items, come up with the percentages. Please use what we have called the common basis. And so that is it. So you can use them to compare two or more companies. Like in this case, we are comparing two companies to determine which is better for the company to take over. Or we've said alternatively, you can use them to compare two or more accounting periods for the same company to again determine in which company performance is considered what? Better, yeah? Any question?
A question?
Yes.
So like based on these percentages, what are you going to use to choose now a better company here based on the statement of financial position?
The same comparison as what we have done under the income statement, yeah? You see, like now, look at property. Let me just give an example with property, yeah? You know, for assets, the more you have, the better. The more the assets you have, the better. If you look at property is 29% for company 𝐵𝐵. Yeah. Then of course, when you look at CEDA, you have that at a less percentage of 16. You know, which ideally means that company 𝐵𝐵 is better in that respect. So the same thing as when you look at something like the owned plant, 21% versus 12%, again, 𝐵𝐵 is considered what? Better. If I come to the liabilities, yeah, if I come down here, let me, for example, look at the lease liability. The less liabilities you have, the better. Remember, the less you have, the better. So that 𝐵𝐵, for example, has 0% compared to 22%. So in that respect, then 𝐵𝐵 is considered what? Better, because the liabilities are what? Less. So that is how still the comparison is done when you come to the balance sheet. Yeah, was that Reu or Reu? Are you the one who asked that question? Who had asked the question, Reu? Or it was someone else? Okay. Sawa. All right. So is that okay? Whoever asked the question, I don't even know who this is.
Yeah, it's okay. It's okay. Thank you. Just Meshach.
Oh, Meshach. All right. Thank you, Meshach. Then that is fine. That is fine. That is fine. So that's it for the common size financial report. So it's one of the tools we can use to do financial statements analysis. But as I said, we have just more than that. You know, I've said we have two tools that we can work with. If I go back to where we introduced this, I said we have two tools. One is the common size financial reports, and then secondly, we do have what? We do have ratios, yeah? So we do have ratios. So let's proceed on to the third sheet in that Excel, the one labeled ratios down here. Let's proceed on to the third sheet, the one labeled ratios. Now, ladies and gentlemen, this is the thing. There is not much to discuss about the ratios really. Again, these are things that you have come across before, so that we know that ratios are a matter of formulas. You only need to know the formula for a ratio for you to apply it, in the context of questions to then answer. And so what I've done is to provide that Excel with various formulas for the ratios. So remember, ratios are classified into categories. One, we have what we call the debt ratios, and the ratios under these are those ones. We also have what we call liquidity ratios, where we have two ratios, the current and quick ratio. Then also we have what we call profitability ratios. The profitability ratios are normally very many, yeah? So that we also have them there. And then the last category is what we call the working capital ratios. Now, all these ratios, you have come across them before, yeah? And so we are not learning anything new as far as the ratios are really concerned. So once you know a formula, given information about, say, an entity, you should be able to calculate now various ratios. For this reason, I will not expressly look at a question computing these ratios really. As we go through the questions, after today, we will be meeting questions where you are required to calculate ratios. And so for this reason, I'll be calculating ratios as we revise through questions in the days to come. So what you need to do is to go through the handout, or rather go through this Excel for the ratios, and make sure that you know as many ratio formulas as possible, because we don't know which ones you will be examined on in the coming exam. So you need to know as many as possible, so that when asked to compute, you should be able to compute them. And not just computing, remember, it is also important you know the interpretation of these ratios, which again I'll assume that you should be able to remember for most of them. Read through this Excel, read through this sheet, and be able to know the formulas for most of the ratios. Do you guys need a detailed handout for these ratios? Because if you do, I can provide, ila inaonesha mpaka theory ya hii vitu, probably to help in the interpretation part.
Yes, you can share. Yes.
Okay. So I should share. You guys like materials, eh? Those formulas are more or less enough, but anyway, let me just provide you with the material. If you want it, I'll provide a PDF Word document, a PDF document that will provide more on the discussion on these ratios. Otherwise, what is important, like I've said, is the formulas. You are most of the formulas for these ratios. That is what is most important. This paper does not have a lot of theory. Actually, it has almost zero theory. This paper is more of it's a practical paper, remember, yeah? And so more often than not, you will be computing things. So nothing much to do with the theory. The theories should be very brief, if at all there will be any. What's important, you'll be able to compute these ratios using formulas. So I'll be providing that handout very shortly in your WhatsApp groups, in your WhatsApp groups. On that note, ladies and gentlemen, we are leaving the ratios behind us. And so I am proceeding on to the next discussion. That is International Accounting Standard number 7. Down here, you can see the sheet labeled cash flow statement. And so let's proceed on to the cash flow. Let's go to the cash flow statement. Let's go to the cash flow statement. So let's go to the cash flow statement. Yeah, so what I want you to do is, again, we shall not be discussing the theory on this thing. We don't need the theories on it. What is important is that, excuse me, you know how to come up with one. Given information about entities, are you able to come up with a statement of what? Cash flow. So this is normally governed by International Accounting Standard number 7. And when you look at this accounting standard, it's very clear that you have two methods which you can use to come up with a statement of cash flow. The two methods including this first one, which we call the indirect. Then there is another one that we call the direct method, yeah? I do advise my students to ignore the direct completely, work with the indirect approach. And so the format for the indirect approach is what I'm providing here. Again, this you have encountered before. You have interacted with this format before. So once again, this should not be an issue. This should not be an issue. It's been, is somebody saying something? All right. It's been an area which the examiner has liked a lot, because we've had the cash flow statement set twice. The first time the cash flow statement was set was in December 2022. The very first exam, it was actually question number 24. So it was actually question number 24. Then again, when you look at last sitting, August 2024, last sitting, this was a question number, I can't quite remember, was it number 21 or what? I think so, 21 or 23, I'm not quite sure, but last sitting, again, we had the statement of cash flow set. So it's been an area which the examiner has liked a lot. So the first thing to remember is the format for this statement. the format for this statement. Importantly, the statement of cash flow categorizes cash flows into three categories. One, we have what we call the operating cash flows, and then we have what we call the investing cash flows, and lastly, we have what we call the financing now cash flows. For that reason, you categorize the cash flows in a statement of cash flow into three groups, so that the statement of cash flow will then have three sections: a section for the operating cash flows, a section for the investing cash flows, and a section for the financing now cash flows. So that that format then is what you need to remember. Now this is the thing. Under the indirect approach, you determine the operating cash flows, by starting with a PBIT. And that PBIT, you adjust it for two things. One is the non-cash and the non-operating items. The non-cash and the non-operating items include items like which one? The depreciations, the amortizations, the impairment, gain or loss on disposal, the investment income. Of course, they are not limited to just those ones. They are not limited to just those ones. You can have many more now here. So you adjust that PBT by those non-cash and the non-operating items, and then also adjust for this which we call the working capital changes. Whenever we talk of working capital, in this context, you are looking at three things. One is normally inventory, the other one is normally receivables, and the other one is normally what? Now payables. When we talk of the working capital changes, we are looking at whether they are decreasing, remember, or increasing. Increase or decrease in these things is what we call the working capital now changes. Of course, you add them downwards. So you add them downwards and get this summation. Now, normally, from this summation, you minus two things. One is taxation paid. How much tax have you paid? And then number two, how much is the interest, interest paid? What you get thereafter is what we call the net operating now cash flow. And then, of course, you proceed on to the investing cash flows. Investing cash flows are majorly to do with two things. One is the cash you pay to purchase your non-current assets. And then secondly, the cash you receive when you dispose the same assets. So majorly those two are what makes up what we are calling the investing cash flows. So examples here, we are looking at the cash paid to acquire non-current assets, and also cash, this is cash, and also cash they received when you have sold the same non-current assets. You may have other items like investment income, and you may also have items like the cash dividend received when you have the associate companies. The associate companies you'll have them under consolidation. So under consolidation, so when you add them, you get the net investing now cash flows. Lastly, the financing cash flows examples include the cash received when you issue shares, the cash received when you borrow loans, the cash you pay when you make loan repayments, the cash dividends paid in general, whether by parent or NCI, and so when you add them, then again you get the net financing. The net financing now cash flows. So that to the net financing cash flows, you then, or rather, when you add the net operating, net investing, and net financing, you get the change in cash and cash equivalents for the period. Now, to which, of course, you add the cash and cash equivalents brought forward, so that you get the cash and cash equivalents what? Now carried forward. I do not want to take much more time on this format thing, because like I've said, you have interacted with, actually cash flow is one of the things you have interacted with the most in your CPA journey. From introduction to financial accounting, you have interacted with cash flows, FR intermediate, advanced FR, all of them you have done the statement of what cash flow. So this format is not really new to anyone. And so at that very moment, what I want us to do, let's illustrate on this thing, because like I said, what is important is being able to come up with one where you are given information about a company. Now, for example, so we have two questions which have been set in the past, the very first exam and then the last sitting. Let's look at this question in the very first exam. The one in the exam for the last sitting you can do later, maybe for practice. And on that note, let's look at the next sheet. Let's look at the next sheet. So let's be looking at that question in December 2022, question 24. So let's look at that question. Now, the question reads that Bermuda Limited presented the following financial statements for the 2 years ended 30th June 2021 and then 30th June 2022. We have statement of profit or loss for the year ended 30th June 2022. The revenue all the way to the point of profit after tax. Then we are told we have a statement of financial position. Remember, normally for 2 years, the current year and then the year before. The questioner then says that we have additional what? The additional info, yeah? And always remember that questions on cash flow are set in the same manner. They will always be set in the same what manner, yeah? In terms of, you will always have the P&L. And that P&L will always be, remember, for the current year. There will also be the balance sheet. But then for the balance sheet, you'll always have 2 balance sheets. One balance sheet for the current year and another balance sheet for the previous what? Previous year. The reason why the balance sheets you must have 2 is so that you have opening and closing balances. Remember, for permanent financial statement items, which include assets, liabilities, and then equity. Thirdly, you will have a bit of the additional info. In accounting, whenever you have this additional info, you know, there are more of items with which you need to have workings. And so you cannot escape workings until, or rather you cannot prepare you cannot do what is required until you have sorted out the additional info. So you must have workings with respect to the additional info before you can do what the question now wants. Ladies and gentlemen, let's look at this additional info. What are we told here? The first one, number 1, that property, plant, and equipment held by the company are items of plant and equipment and freehold premises. Now, during the year ended 30th June 2022, items of plant and equipment which originally cost 40 million shillings were disposed of, resulting in a loss, remember, of 6 million shillings, which was charged, we are told, in the administrative what? Now, expenses. The question then says that these items had a net book value, remember, of how many millions? 28 million at the date of what? Now, disposal. There are a number of things there. We did dispose an item of plant. The cost of the item of plant, we are told, was 28 million. We disposed it for a loss, which was 6 million shillings. At the time we disposed it, the book value for it, we are told, was 28 million. Now, the first thing to remember is that as we prepare the statement of cash flow later, one of the adjustments will be this disposal loss. We have said that as part of what we have called the non-cash items, which you are just under the operating cash flows, we do have this disposal loss. So very fortunately, the question has given us this disposal loss. Other questions will require that you compute it yourself. So in this case, because we have it, then directly to the statement of cash flow, we will have the disposal loss of how much? Now 6 million. But the fact that the question gives the 6 million means there is something which we need. There is something which we need that the question has not what? Provided. And what is this thing? What about disposal that the question has not provided that we must compute? You know, I'll say down here that we have the solution to this thing. We have the solution to this. We have the solution to this question. And the starting point, I'm saying we have workings. Now, working number one, let us determine what? You know, we are given everything about this disposal, but what we are not given directly that we need and we must compute is the cash. The cash received from what? The disposal. The disposal. At the time we disposed the asset, the book value, we are told was 28 million. If we disposed it for 6 million, somebody, how much cash did we receive on this sale? So how much money did we receive from the sale of the asset? If book value was 28 million, then we sold it for a loss of 6 million. For how much cash did we sell it? Yeah, 22 million. That's correct. So 22 million. So note that the cash from disposal is therefore 22 million. You don't need to compute anything here. If the book value was 28, and then we have disposed at a loss of 6, then the cash from disposal was therefore 28 what? 28 million. Why am I determining this thing? I am determining this thing because this is part of the investing what? The investing cash flows. So later in the statement of cash flow, we will have this as part of the investing what? Now cash flows. So you must determine that. What follows? Working number 2. So working number 2. Now, what else? Again, remember that the moment you dispose, you know what are we disposing here? We are disposing property, plant, and equipment. And what we have disposed must be, you know, when you come back to this balance sheet, one of the items we have is this PPE, property, plant, and what? And equipment. That means you must adjust the account for PPE by that disposal what? Thing. And so one more working which I will have down here is on PPE. Remember is on what? On PPE. Remember is on PPE. Now the question says that I don't know whether do I compute, do I look at this vertically or I prepare an account. We can prepare an account so that I show you how to prepare accounts in Excel. You can do a T account in Excel, like, but doing accounts in Excel is just about just work with the borders. You just work with the borders for you just work with the borders. You just work with the borders, probably to there. just work with the borders to come up with the T accounts. The normal borders, the normal cell borders, so that this is a PPE account. So PPE account. We will start with on the debit, what is the balance brought forward, and then on the credit, what is the balance what now carried forward. The brought forward balance we are told is what figure. So just work with the normal borders to come up with an account. The normal borders are what you work with to come up with an account, so that the balance brought forward for these are assets. So assets are debits. So the balance brought forward, the balance is brought forward. You debit them. Assets are normally debits. The brought forward balances are the ones under which balance sheet. You know, we have balance sheet for 2021 and then 2022. So the current year is 2022. 2021 is the previous year. And so that balance sheet gives us the balances what brought forward. So under 2021, this is 327. So I'll just say here that this equals this 327. And then the balance carried forward, and in the balance sheet for the current year, this is 264. Now, what adjustments do I need to make? First, I want to adjust for the plant disposed. And you know, disposal means that you decrease PPE, because PPE is a debit. To decrease it on the credit, you'll say that we have disposal. The asset disposed had a book value of 28 million. The asset disposed had a book value of how much? Remember, 28 million. So you credit a PPE account with the 28 million. What else do we adjust for here? Let's look at this note number 2. There's something about PPE in note number 2, where we are told that depreciation charge the year ended 30th June 2022 was 43 million. You know, depreciation also decreases PPE, and so in a PPE account to decrease again credit 43 million, say that this is what? Depreciation. So that's depreciation. What else do we need to adjust in this PPE account? Note number 3, we have nothing here. But then I think just one more thing. Let's go back to the balance sheet. The PPE can also adjust by now. The other item in this balance sheet which adjusts PPE, remember, is this revaluation thing. You know, we have this revaluation issue. As per International Accounting Standard number 16, IAS number 16 is about PPE. Revaluation is with respect to PPE alone. PPE alone. So whenever you see revaluation anywhere, then what you must have revalued is PPE. And you know, revaluing means you either increase or decrease PPE value. Now, ladies and gentlemen, appreciate it. Let's compare the opening balance for this revaluation with the closing balance, so that let's agree. The opening balance, we have this 36. The closing balance, we have this 60 what? Now 7. What happened to the revaluation reserve? The revaluation reserve increased. What makes the revaluation reserve increase? When you have increased PPE in value through revaluation. When this reserve increases, It means you must have increased your PPE in what? In value. If this is increasing this way, then we must have increased our PPE account in value so that you debit and say that this is our revaluation what? This is our revaluation increase. This is our revaluation increase. Increasing PPE means that you debit it so that on the debit, the increase we have what figure? The increase we have this 67 minus this 36. So minus that 36, so minus that 36. Now this comes to about what figure? About 31. Is there anything else about this PPE account? I haven't seen on anything else. So what we'll do is to balance off the PPE account and find out how much is the difference and what then is that difference that you what get. So that when you balance off the PPE account, which side is more? And you'll give me a minute.
You're not supposed to use the amount of. Thank you.
All right, now let's do this because I'm seeing there is a problem with something has been reversed in this question. These years, these years have been reversed. Can you change? This is what should be 2022, and this should be 2021. So this is 2022, and then this is 2021. That is how it should be. Yeah, I'm looking at the original question. So whoever typed this question for me, I think must have reversed the accounting years. So this is what is 2022, and then this is 2021. So please change that, and that will mean that we must reverse these opening and closing balances. Yeah, so the brought forward is not 327. The brought forward is 264, and then the carried forward is the one which is 320, 327. So it won't make sense if we do it the way it was before. So reverse the opening and closing balances. So this is 2022, then this is 2021. So please change that. All right, so let me hope you have done that. So if you have done that, then we can balance off the PPE account. So if you balance off the PPE account, which side is more? The credit side will be more at a total of 398, meaning that the debit will also have 398. Is somebody saying something? Oh, so this is now, this is now a revaluation decrease. So we have to change this. That's now a revaluation decrease. Yeah, so if the opening balance was, the opening balance for the revaluation was 67, the closing balance is now 36. So that is true. On the credit instead, we now have a revaluation decrease. Revaluation decrease. That's a bit confusing for me. The change of those years. The decrease, revaluation decrease is what figure? You know, it's now 67 minus this 36. Now 67 minus that 36. And that comes to 31. So this total must change. So this total changes to, yeah, that's fine, 429. So the total changes to 429. So on the debit, we then have the brought forward balance only. Now, what we are interested in and what we determine is then how much is the balancing figure and what is that balancing figure. So the balancing figure is there for this 429. You minus the brought forward balance 264. And the balancing figure comes to about 160.5. So that comes to about 16165. Who can remember what the 165 is? Who can remember what the 165
Acquisition.
would be. Yes.
Acquisition.
Yeah, this is now you see the PPE account is a debit. It is a debit. It is a debit balance account, meaning that anything that you debit here increases a PPE. What is this 165 that is then increasing the PPE account? This must be an asset we purchased. And because we are looking at the statement of cash flow, then this must be a cash purchase. And you know, we have said that all cash purchases of assets are what cash flows? Investing cash flow. So later, again, as we look at the investing cash flows, we'll have this cash purchase of PPE. Remember 160 what? Now 5. Working number 3. Now note number 3 says that 50 million shillings of convertible loan stock was converted to 50 million shillings ordinary share capital at par during the year ended 30th June, remember 2022. So that we converted a loan into ordinary what? Now shares. Let's agree, ladies and gentlemen. If I come back to the balance sheet, the loan stock is actually this non-current liability, this one here. At the start of the period, we had 150. At the end of the period, we have 100 what? Million. Why is there the decrease by 50? The decrease by 50 is because of this conversion as per note number what? 3. When you convert a loan, you know you cancel it. So the difference of 50 is what we canceled. Instead of the 50, we issued ordinary what? Shares. We issued ordinary share capital worth the same 50 million shillings. So the loan has decreased. The decrease in the loan of 50 is because of the conversion. So nothing else, there's nothing else about that loan. So the decrease is purely because of that conversion. Now instead, we issued ordinary share capital. Look here, the ordinary share capital issued was an amount of 50. You know, at the start of the period, the share capital was 150. We issued 50. You know, at the end of the period, we now have 200 and what? 230. Now, if you take the 50 issued and you add to this opening balance of 150, you know, that gets you to 200. But then at the end of the period, we have 230. What is that extra 30? That extra 30 must be another issue, which is now in what? In cash. So the next thing I'll do is to then compute the cash from issue of what? Now shares. How much cash in total am I receiving from issue of what? Issue of shares. Now I can prepare an account like this one, or alternatively I can compute this thing vertical. I can say that the balance brought forward, or rather I can say that the balance brought forward for the ordinary shares. So let me say that this is ordinary share capital, balance brought forward. So how much is this? This is 150. Now I am increasing this. I am increasing this by loan stock converted. By loan stock converted. I am increasing this by loan stock converted. We are told we converted 50 million. So we increased the ordinary shares by 50 million. We increased the ordinary shares by what? By 50 million. We have agreed that we then have the cash issue. We then have the cash issue so that the ordinary share capital balance carried forward. The closing balance is how much? The closing balance is 230. The closing balance is 230. The cash from issue, you know, is there for this 230 minus this 150 minus this 50. So cash from issue is there for how much? 30. If you don't like it that way, you can prepare the account. The problem with the account is that they waste time. The problem with preparing the accounts is that they waste your what? Your time. So yeah, so you can prepare an account to calculate that 30 or just look at it this way. I hope that is clear. But let's remember that this cash issue must be at what value? At par value. Because the ordinary share capital is normally recorded at what? At par. Sometimes the issue can be done at a share premium, in which case, not only do you have this cash for the issue at par value, but you'll also have cash for the share premium. So let's check whether the share premium also increased, in which case there would be cash from share premium also. So let's go back to the balance sheet and let's check the share premium. So the share premium is here. The share premium is there. You cannot look at the ordinary share capital leaving out the share premium. You must look at the two together. You must look at the two together. So the share premium also increased from 0 to 30, meaning that there was also cash. Remember, for the share what? Share premium. This will mean that therefore, the total cash from shares issue, now this equals how much? This equals this 30 plus, you know, we've seen that the share premium increased from 0 to 30. So plus the increase, which is how much? 30. Plus the increase, which is 30. So that total cash from our shares issue, we therefore have what figure? 60. Later on, this will be a financing. In the statement of cash flow, this is a financing what? Cash flow. So in the statement of cash flow, that will be a financing what? Now cash flow. Let's look at working number 4. Now for working number 4, let's now look at what? We are done with the additional info. Can we now look at, let's go to the balance sheet and look through these items one by one. Tutaangalia kila moja ya hapa kwa balance sheet. Let's start with the intangible assets. You know, we are done with the PPE. Let's look at the intangible assets. Now, what has happened to the intangible assets? Let's agree The intangible assets have decreased from 50 to 40. When intangible assets decrease, what do you call this thing? When intangible assets decrease, what do you call the decrease?
Impairment.
Impairment loss.
Is it impairment or is it amortization?
Impairment.
Impairment. Now, let me make this clarification. Yeah? When we talk of intangible assets, when we talk of intangible assets, we categorize them into two. We have goodwill, and then we have, allow me to call them the others. And by others, we mean the copyrights. By the others, we mean the copyrights. We mean the patents. So copyrights, patents, now etc. We do not, for goodwill, when goodwill decreases in value, and this is the provision of IFRS 3. When goodwill decreases in value, actually IFRS 3 and IFRS 3, when goodwill decreases in value, you call that impairment. When goodwill decreases in value, you call that impairment. The other intangible assets, when they decrease in value, you know you shall be referring to IAS number 26. And when you look at the provisions of IAS 26, these other intangible assets you amortize. You amortize, so that's amortization. So the other intangible assets you amortize, it is only goodwill which you impair. And let me make it very clear. Unless you are told that this is goodwill, then we'll treat this as the other intangible asset, so that that decrease is not impairment, but amortization. So that we have amortization of intangible assets. We have the amortization of intangible assets. The amortization is what figure? The decrease which is 50, so 50 minus 40. So that the amortization is there for how much? 10. So in case that was goodwill, then you would call this one what? Impairment. So this one you will adjust under the operating. So later we'll adjust this under the operating what? Cash flows. Working number 5. Let's look at working number what? 5. The next asset we have, after the intangible assets, we have this one. We have the financial assets through the other comprehensive incomes. So we have the financial assets through the other comprehensive what? Comprehensive income. Now, ladies and gentlemen, let's agree. Their starting value, we have this 10. Their ending value, we have this 20 what? 22. So these assets have what? Increased. When these assets have increased, we must find out why. So let's say down here that they are called the financial assets through OCI. So let me call them financial assets through OCI. balance brought forward. They are brought forward balance, we have what? We have 10. So they are brought forward balance, we have how much? We have 10. Now, these assets are increasing in value. Why are they increasing in value? Hebu tukubaliane, eh? The first cause of the increase in value is, can you come to under equity? I want you to come to under equity. Under equity. So come to under equity. And under equity, we have this asset or this item, I mean, we call the financial asset through OCI. This is called equity reserve. And the opening value we have 0, the closing value we have 2. Let me explain this. This is more or less like the revaluation reserve for these financial assets. You see, like in the same manner we do have revaluation reserve for PPE, these assets are also what? Revalued. The fact that this reserve has increased means that we increased these assets in value, more or less like a revaluation increase. And so, if that is the case, then here we will say that we have the revaluation increase. Allow me to use this word, though it is not the right word for these ones. We have the revaluation increase on them. The revaluation increase we have seen is, you know, it is this 2 minus 0. The increase is 2. The increase is what? Is 2. Please note that their balance carried forward. Their balance carried forward. Their balance carried what? Carried forward. So how much is this? Their balance carried forward, we have how much? Their balance carried forward was this 22. Their balance carried forward was that 22. So ladies and gentlemen, let's agree. If the opening balance was 10, and then we revalued them for an increase of 2, if the closing balance is 22, you know, it means that we have that other increase, the 22 minus 10 minus 2. We have that other increase of how much? 10. What is this other increase? Just like we saw that this one more increase then become a cash what? A cash purchase. In other words, we again purchased these other assets in cash, and the cash purchase is therefore 10. Because this is purchase of a non-current asset, this will also be an investing what? Cash flow later. So another investing cash flow is then that 10. So later in the statement of cash flow, we'll have that other investing cash flow of how much? Now 10 million. Let's look at the next asset. Now, after the financial assets are through OCI, current assets are next. Now, skip inventory, also skip the trade receivables. For those ones, you know, we just look for an increase or decrease as part of the working capital, what changes. Now, but one more current asset that we do have are these financial assets at fair value, and then also cash and cash what? Cash and cash equivalent. Now these ones, these two, they make part of what we call the cash and cash what? Cash and cash equivalents. So that down here as working number 6, because we'll need this later in the statement of cash flow, let's look for cash and cash equivalents. cash and cash equivalents brought forward and carried forward. The cash and cash equivalents brought forward and what? Now carried forward. Let me have a column for the brought forward. Let me also have a column for the carried forward. Later in the statement of cash flow, we need these two things. The cash and cash equivalents brought forward and carried forward. Now allow me to say this, that the cash and cash equivalents brought forward do comprise cash, also do comprise bank. And you know, for the bank, it can be a positive. For the bank, it can be a positive or an overdraft, And then also financial assets, current, and also financial assets which are what? Which are current. So when we talk of the cash and cash equivalents, then we are looking at the whole of that summation. So then we are looking at the whole of that summation. You combine those three things. So you combine those three. And so here, number one, we will appreciate that we have these financial assets at fair value. And then we also have what? And then we also have cash and cash equivalents. So those ones first. They are brought forward figures. We had what and what? The financial assets at fair value, you know, brought forward, we had brought forward was this 30. So that 30. And then the cash brought forward was how much? The cash brought forward was 0. The cash brought forward was 0. The carried forward figures are now these ones in these are the balance sheet now 65. And then cash and cash equivalents, we are told that's 20 what? 29. So we are told that's 20. That's 29. So ladies and gentlemen, let's agree. Were we to increase the brought forward balances, or rather even before that, was there a bank overdraft? Check under the current liabilities. Check under the current liabilities. And yes, there was the bank overdraft. You know, we have the bank overdraft here. We have the bank overdraft. And so you must include the bank overdraft also. Bank overdraft. We have the brought forward was 22. The carried forward is a 0. So carried forward is 0. The brought forward is equal to this 22. Now let's be very clear on this. A bank overdraft is normally a minus. So you must have that as a minus. The bank overdraft is a negative. So you must have that as a what? As a negative. That's a minus. So that's a minus. The bank overdraft is a minus. The bank overdraft is a what? Is a minus. So you must have that as a minus. As a minus. All right. So is that all? So I've said that the cash and cash equivalents comprises these three things. The cash, the bank can be a plus or a minus. A minus is an overdraft, like I now have this negative. And then the financial assets are current ones. When you have current financial assets, these ones are also classified as part of the cash and the cash what? Cash equivalents. What other change? What other adjustment, do we need to have on these assets? The other adjustment, come here, let's come to the P&L. 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 Now, one of the items in this P&L, one of the items in this P&L, we are told that we have these financial assets, or rather added to the gross profit. We have this gain on financial assets at what? At fair value. The gain was 5 million. In other words, these assets are gained value this year. They gained value this year by 5 million. You know, gain in value is still more or less like that revaluation thing. In other words, we revalued upwards these assets by 5 million. When we revalued them upwards by 5 million, it means we increased their balance what? Brought forward, their balance brought forward increased by 5 million. So we are going to have under the brought forward the 5 and say that this is a gain. This is gain on fair value. That is gain on what? Fair value. When you increase them in value, then their brought forward figure is what you increased in value by the 5, so that you get the carried forward what? Now values. And if that is the case, that is it. If that is the case, that is it. You know, we can then add them downwards. We can then add them downwards, so that brought forward is 13, and then the carried forward is 90 what? 94. These two will later be presented, remember, in the statement of what? Now cash flow. Working number 7. Let's go to working number 7. So let's go to working number 7. The next item I want us to look at is which one? So we are done with the current assets. Allow me to come to equity, where we are done with share capital. We are also done with the share premium. We are done with the revaluation reserve. We are also done with these financial assets through OCI. The last item here is the retained profits. Based on the retained profits, we should normally compute what? We should normally compute the cash dividends paid, because whenever we pay dividends, we pay them out of what? Profits. So change in our profits is in most cases due to payment of what? Now dividends. Now, the retained earnings balance brought forward. How much is this? The brought forward balance for the retained earnings, we have how much? This one is 91. The first thing that increases the retained earnings brought forward is normally the profit for the year. Is normally the profits for when? For the year. How much profits have we made this year? Can you go back to this year's P&L? So equal to the P&L for this year. Go back to the income statement for the year. The profit after tax for the year, we have this 60 what? 67. The profits after tax for the year, we have that 60 what? 67. So I will have that 67. In case you have dividends, in case you have the cash dividends paid, then you minus them from here, so that, remember, we get the balance what? carried forward for the retained earnings. So that how much is the balance carried forward? For the balance carried forward, you go back to the balance sheet. The carried forward balance under this other balance sheet, we have 121. So the difference is then the cash dividends what paid. You know, this is more or less like the statement of changes in equity, the retained profits what column. You do start with the balance brought forward, remember, plus profit for the year. You do minus dividends so that you get the balance what now carried forward. So how much is the cash dividends now paid? Let's work backwards. Equal to now, you now take this brought forward 91. Remember, plus, let me just compute it as a minus. So I take this closing minus this, minus this. So the paid cash dividends, we therefore have that 30 what? 37. So we therefore have that 37. So this one, dividends paid are financing cash flows. Dividends paid are financing what? Cash flows. So later, we will present that as part of the financing what? Cash flows. Later, we'll present that as part of the financing cash flows. So later, we'll present that as part of the financing cash flows. Now, what else do we need to compute? Number eight, when I come back to my balance sheet still, the non-current liabilities, the loan stock, I think we've seen the change of 50 was due to conversion of loan stock of 50 million. So we've seen on that. Under current liabilities, we have bank overdraft. We've dealt with that. The trade payables, skip it. That's part of working capital, which we'll find out whether it's increased or decreased. Now, interest payable and then the income tax payable. Normally, you must compute the interest and tax paid in cash. You must always compute interest and then taxation paid in what? Paid in cash. So you must always compute interest and then taxation paid in what? Paid in cash. So let me have a column for interest. And then let me have a column for tax. We want the amounts that were paid in cash for the two items. We compute them from the two liabilities, interest payable and tax payable. So we will say that the balances are brought forward for the two liabilities. The balances are brought forward for the two liabilities. Interest brought forward, we have how much? The interest brought forward, we have 3. That's 3. And then the tax brought forward, we have how much? We have 34. We have 34. We do increase the balances brought forward by what? By the charges for these things for the year. So you adjust the brought forward by the charge for the year. Where do we get the charge for the year? You get them in the P&L. So go back to your statement of profit or loss. Go back to the statement of profit or what? Or loss. Now, interest is what is referred to as finance cost. So in the P&L, look for finance what? Look for finance cost. And you know finance cost, we have this 17. So I'll come down here and say that interest for the period, you know we have this 17. And then tax for the period, I'll say equal to negative this because I want it as a positive. Tax here is a negative. So it is this income tax expense of 47. So I'll present it down there as a positive, We are looking for the cash paid. We are looking for the cash what? Paid. We are looking for the cash paid. That's what we are looking for, the cash paid. For us to compute the cash paid, first of all, we need their liabilities, balances carried forward. What were the liabilities, balances carried forward? The carried forward balances are in the balance sheet. So the carried forward for interest is this 7. The carried forward for tax is 19. So you now work the cash paid from here. You now work the cash paid from here. So let's agree that if the balance brought forward for interest is 3, and then the charge for the year is 17, the total owed is 20. 3 plus 17 is 20. If at the end of the year we have 7, then we have paid a total of how much? So 3 plus 17 minus 7. What we have paid is therefore 13. The cash paid is 13. The same thing for the taxation. So I just drag the formula. And ladies and gentlemen, these two cash flows are presented as part of the operating what? Cash flows. Those two are presented as part of the operating, what? Cash flows. So those two are presented as part of the operating cash flows. So you must first of all have the workings that way before you can present the statement of what? Cash flow. I don't know whether there's a way of doing this thing without having the workings first. But the truth is you cannot prepare the cash flow without the workings first. In financial reporting, the moment you have to do financial reports, then workings must come first. With that in mind, let's now answer the question. Please note that our workings have no marks. The workings have 0 marks, 0. All the marks, all the 20 marks are allocated for this statement of what? Cash flow, all of them. The name of the company, we have Bermuda Limited. The year ends in 30th June 2022. So down here, I will start with a title. This is Bermuda. You must always start with a title, remember. Bermuda Limited.
So
I'll say
Mwalimu,
that a statement of cash flow for the period to 30th June. This is 2022. Bermuda Limited statement of cash flow for the period to 30th June. The year is 2020 what? 2022. 30th June. The year is 2022. We have shillings in millions. You must always start with a title. You must always start with a title. For the columns for the amounts, you must have 2 columns for the amounts. You must have 2 columns for the amount. So you must have 2 columns for the amount. So the first column, the second one. We do start with the operating. We do start with the operating cash flows. So we do start with the operating what? The operating cash flows. We do start with the operating cash flows. And under the operating cash flows, what did we say that we begin with? Under the operating cash flows, what did we say that we start with?
Profit before interest and tax.
Yeah, you start with profits before interest and what tax. But let me make a point very clear here. In the context of the information that the question will provide, you cannot directly have PBIT, because when you go back to the P&L, yeah, the only profit before something which we have is a profit before what? Before tax. For this reason, ladies and gentlemen, you will always start with that PBT. Always you'll start with a PBT, and under the first amount column, we'll have that PBT, and the PBT we had 114. Let me make a point clear. You must start with PBT. Why? Because in our income statement, we do not have PBIT. We don't have that thing. What we have is PBT. But when you start with a PBT, remember, this is after. PBT is after I. I is interest. Remember, PBT is normally after what? I, which is interest. The PBT is normally after I. Whereas we are saying what? We should start with our profits before interest also. What this means is simple. As we then adjust for the non-cash, and non-operating, as we then adjust for the non-cash and the non-operating items, as we then adjust for the non-cash and the non-operating items, we must first of all do something with the interest. We must first of all do something with the interest so that our profit is before interest also. Somebody, what do we do with interest so that we make our profits be before interest also? Do we add back the interest or do we minus the interest? Unajua, kumbuka hivi. When you start with PBT 114, this is after you have deducted interest of 17. But we want our profits to be before this interest. What do we do with the interest of 17? Do we add it back or do we again minus it? Which is, we add it back so that equal to, can you add back this 17? Add it back. So you add back the 17, you add back the 17. Now, let's have our non-cash items. Which non-cash items do we have? There are very many. Somebody to give me one. Which non-cash items do we have? The first one is depreciation. So let's have it. The first one is depreciation. So let's have it. So one, we have depreciation. There are very many. Depreciation was what figure? You add back the depreciation, remember. So it was this 43. Depreciation was 43. We have also seen that we have amortization. How much amortization did we compute? We computed that thing somewhere. This working number 4, 10. So add back 10. There was also disposal what? There was also disposal loss. There was also disposal what? Loss. Not number 1. The loss was given to us at 6 million, remember? So you add back the 6 million. If it is a gain, if it is a disposal gain, you minus. For the loss, you add it back. Now, what else? I don't think that is all. Another non-cash item is which one? Another non-cash item is this thing in the income statement called the gain on financial assets at fair value. You know, added to the profit was the gain on financial assets at fair value. This 5, this one here. That thing is not cash in any way. Anything gain or loss, that's not cash. So because this one was a plus, unajua hii iliongezwa kwa profits, to adjust for it, you now minus that thing. So equal to negative this 5, negative that 5. One more. Now this one is not non-cash. This one is non-operating. The non-operating item here is this investment income. The non-operating item there is that investment what? Income, because it was also added. Can you minus it? Remove the 6. Remove it now. The investment income I'm saying is not non-cash. The investment income is actually cash. It is actually cash. So unlike these others, which are non-cash, the investment income is what? Cash. What is the problem with it at this point? The problem with it at this point is that it is non-operating. You know, an investing income is not an operating cash flow. That's an investing cash flow. So we remove it from here. Later, under the investing cash flows, we will add it back. And so that is it. That point, ladies and gentlemen, that's it. So these ones, all this you put under the first amount what? Under the first amount column, all that. And so at that point, we add them downwards. We add them downwards. So we get 170 what? 179. At this point, you then introduce the working capital changes. This format is standard, remember. This format won't change. At this point, we then introduce the working capital. We then introduce the working capital changes. Now, working capital, you have 3 things. The working capital include inventory, the receivables, and then the trade payables. The inventory, the trade receivables, and then the trade what? Payables. The changes we are looking for is whether they have increased or what? Decreased. So I'll come back here and let's start with the inventory. Inventory is here. The inventory, we have it here. At the start of the period, 176. At the end of the period, we have 123. So they have decreased. So we'll say that the first one, we have decrease in inventory. When inventory is decreased, is it a plus or is it a minus? When inventory is decreased, you know, it means you have sold them. Inventory stocks will decrease when you have sold. So a decrease is a plus. A decrease is a plus. So we'll bring here the difference as a plus. Meaning I take, as a plus, I take 176 minus 123. So that's a plus, 53. The next one, we have the trade receivables. The trade receivables have, on the other hand, increased 87 to 95 is an increase, So next we'll have increase in receivables. Increase in receivables, and this is how much? The receivables will increase when you have given out more credit. When you give out more credit, that's an outflow. So increase in assets is normally a minus, because that means you are spending money. When you give out more credit, that's a minus. Lastly, the trade payables. The trade payables have on the other hand increased 100 to 156. Now that's an increase. So we'll talk over, we have increase in trade payables. In trade payables, when the payables increase, it is a plus. It is a plus. So 156 minus 100. So that's a plus. Because that is it. Because that is it for the working capital. Then again, we add them downwards. So we add them downwards from 179 to there. Down there, we get 280. We get 280. At this point, you will always minus two things. One is interest paid. Number two, tax paid. I have said that this format is the same. So interest paid and then taxation paid. This format is the same. The payments are negative. So these ones will come here as minus 13 and then my equal to minus 62. We have computed everything. So I'm simply copying what we have already computed here. And so at this point, we add them. We get what we call the net. The net operating. We are done with the operating cash flows. And so this is the net operating what? Cash flow. We are done with the operating cash flows. And so that is the net operating what? Cash flow. So that's the net operating cash flow, which you now put under the second amount column. And this will equal, I'll say that this equals the sum of what? The sum of these three. So you put that under the second amount column, 205. So 205. At that point, I will pause and ask the question whether somebody has any question to that point. Is there a question to that point? Kuna swali hadi hapo before we proceed on to the next section of the statement of cash flow. Is there any question? None. If there is none, then we proceed on to the investing cash flows. The investing cash flows are to do with majorly two things. One is the cash you have paid to buy non-current assets. Number two, cash you have received when you've sold the non-current assets. Now let's start with the cash paid to purchase PPE. One, there was cash paid to purchase now PPE. To purchase PPE, we go back to the PPE account and cash paid is a minus. Cash paid is a minus. We computed 165. So I copy that from there. Minus 165. Oh, let me have my figures as accounting figures so that they look more beautiful. Yeah, so that will be better. So 165 minus. There was also cash paid to purchase. Cash paid to purchase. Cash paid to purchase financial assets through OCI. We also purchased financial assets through OCI, and this equals negative. This equals negative what? Now this equals the financial asset through OCI was this working number 5, 10. We paid 10. The cash paid to purchase financial asset through OCI was 10. And then there was a cash received from disposal. There was cash received from disposal. There was cash received from disposal of PPE. This equals, we computed this in this working number 1. Cash from disposal, we computed 22 million. So that's a plus. That one you receive, and so that is a what? That is a plus. So that one you receive, and so that is a what? That's a plus. Which other investing cash flow do we have? The other investing cash flow that we have is, remember, there was investment income. There was this investment income. We said it is non-operating. So we removed it from the operating. We brought it to its category, which is the investing. So we have positive +5. We removed it from operating. You add it back under investing. So under investing, now that's a plus. I don't think there is anything else about these investing cash flows. And so let's determine the net investing cash flow. What is the total for this category? The net investing cash flow. So again, under the second amount column, the sum of all this. So the sum of all that, 147 minus. So that's 147 minus 147 minus. So 147 minus. Again, is there any question on the investing cash flows? Is there any question on the investing cash flows? Any question on this? Is there any question on the investing cash flows? None. The last category, so that we finish on the cash flow, is financing. Is financing cash flows. Which financing cash flows do we have here? I don't think there were very many. I haven't seen many of them. There was one. There was cash from issue of shares. Cash from issue of shares. The cash from issue of shares is a plus because we received that money. You check working number 3, cash from issue of shares. The total we computed 60. The total we computed how much? 60. The total we computed 60. So the total we computed 60. So it's a plus 60 down there. And then there was also cash dividends paid. Dividends paid are all financing cash flows. The cash dividends paid. Now this one is a minus because it's a payment. So this one is a minus. Working number 7, we computed this. So I'll not say equal to minus this one because it is a minus already. I'll just say equal to that minus 37. I'll have 37 down here. Did we really have another financing cash flow? Let me check. Did we really have another financing cash flow? We don't, I don't think we have another one. So that is it. That is it. Let's compute the net. The net financing cash flow. So this will be the sum of equal to the sum of these two. Yeah, so that's 23 plus And then once we have the net for the three categories, we then total that second column to how much? This will equal the sum of these three. They total to 81. So this is what we call the change. This 81 is change in cash and cash equivalents for the year. Change in cash and cash equivalents for the year. At this point, you introduce the cash and cash equivalents brought forward so that we get the cash and cash equivalents now carried forward. So cash and cash equivalents brought forward, and then cash and cash equivalents carried forward. We have computed all these things, so we get them from their working. So that this equals the working for this one. Yeah, look at working number 6. Cash and cash equivalents brought forward and carried forward. Brought forward was this 13. So that carried forward, we computed 94. Now, ladies and gentlemen, remember, when you add this 81 plus this 13, you should get 94 for your statement of cash flow to reconcile. When you take 81 plus 13, you should get 94. So that, of course, in exams, you'll not be able to reconcile these things. So don't waste your time trying to reconcile anything. Do what you can do and proceed on to other questions. But of course, in an ideal setup, the statement of cash flow reconciles that way. Nani yako na swali? Is there any question? Allow me to be very clear once again. I've mentioned this, but let me be even clearer, that the workings have no marks. There is no mark for any of those workings which we've had, no mark. The marks are allocated for the statement alone, so that, like in this case, this is how we awarded marks for this question. So that marks, this is how we awarded marks for this question. Okay. So every entry would have a mark. Except the totals will not have marks. The totals don't have marks. The totals do not have. So all these are awarded 1 mark. So including the cash and cash equivalents brought forward and carried forward. So when you total all these, there are a total of, yeah, you can see there are a total of 20 marks. You can see there are a total of 20 marks, yeah? So each correct entry has 1 mark. No marks for the workings at all. All the marks on the entries in the statement of cash flow without the totals. Totals are never awarded what? Marks. And so that is it for the statement of what? Cash flow. So fortunately, you have interacted so many times with the statement of cash flow. It should not be an issue really. What you need to note is the format of the statement of what? Cash flow. Nani yako na swali?
So is it okay to do the workings on a separate sheet of paper, then come back again and plot them in the Excel?
There is no problem, but I don't like it that way. For the reason that don't make your Excel sheet very bulky. Yeah? Don't have so many sheets. Just do, if you choose one sheet, just do the workings there. And then the answer also there. Don't have too many sheets. It gives the marker a lot of work.
Okay.
Any other question? Is there any other question? All right, so that is it for the statement of cash flow. So this has been set twice, like I said, the very first exam, then the last sitting. We've done the question for the very first exam. You can allocate the question for the last sitting and please attempt it. You can use that for your revision purposes. The next discussion will be published. The published financial statements. So your syllabus does not really talk about published financial statements. Your syllabus talks about preparation. Your syllabus talks about preparation of financial statements. That's what your syllabus talks about. And as part of preparing financial statements, we have what we call the published financial what? Now statement. So again, this is something you have interacted with before. And so we'll not be dwelling much on really discussing this. Focus will be on how you prepare these financial what statements. There's nobody to this level you are in who does not know how to come up with financial what statements. So we shall simply use an illustration to show how financial statements are what? Prepared, especially the published financial what? Now statements. It is exactly 11:06. It is exactly 11:06. Don't you think we should be taking a very short break? Hata kama ni ya kukunywa maji. What do you think?
Yes, we can come back at 11:30, kindly.
11:30, that is how many minutes from now? No, too much time. If we come back at 11:30, I'll go slightly beyond 1. So yeah, nevertheless, I must finish to illustrate the published financial statements. This is what I'll do. Yeah. Again, I'll be looking at a past paper question, which is December 2023. This has been set before. December 2023. It is actually question 21 that will help us to illustrate how to prepare financial statements, more specifically, how to do the published financial statements. So that is the next sheet in your Excel, yeah? Yeah, this question of 𝗪𝐵𝐶𝐺 Limited. These are past paper question. So let's come back at 11:30. Now, I must finish this question. I must finish it. So I must finish it. So let's meet in the next 23 minutes when we then continue from there. So I will not be canceling the class. I'll just let the session remain open, but until 11:30. So enjoy your short break. I'll see you guys in about 20 minutes. So let's meet at 11:30. All right, so I think we can continue. We can continue, and let me hope you have read the question so that we can proceed on to have the solution for it. Now, when I look at what the question wants, down here we are told that required as per International Accounting Standard number 1, we prepare a statement of profit or loss and other comprehensive incomes, followed by the statement of changes in equity, and then also we prepare the statement of financial position. Now you have to remember that before you can prepare the 3 reports, first of all, you have this additional info. And so the first thing is to sort out the additional what? The additional info. So you must have workings with respect to the additional info, yeah? So let me say down here that for the solution, let us start with the workings. So let us start with workings. And working number 1, let's start with note number 1. So we are told inventory is provided at 97 million at cost, and then 95 at 250 at net realizable what? Realizable value. Now, why have we been given 2 values for this inventory? And the question is, what value do we then use for the inventory? Listen to this. Inventory is governed by International Accounting Standard number 2. And what normally IS2 wants is that value inventory at the lower of the cost of the inventory and what? And NRV. NRV is the net realizable value. So when then you have 2 values for the inventory, take the lower between what? Between the 2. So I'll say down here, that is working number 1, we have closing. We have closing inventory, and that inventory at the lower value, the least value here is which one? 97, 95. 95 is the lower, yeah? So I'll say that we have 95, remember 250. We have 95 Remember 200 and what? 250. All my workings will be shillings in thousands. Why I've chosen shillings in thousands is because the trial balance which we were given is also in what? In thousands, yeah? So let's have all the workings in shillings in what? In thousands. All right. What follows? Let's look at note number 2. So the closing inventory value, we therefore work with this 95, now 250. Please remember that I still require that value your inventory at the lower of cost and NRV. All right, let's look at working number 2. Note number 2 says that, what does note number 2 say? So note number 2 say that at the start of the year, 𝗪𝗪𝐶 Limited had disposed of some old equipment for 1,750,000. The equipment had cost 3.7 million, 3.75 million, and then had accumulated depreciation brought forward at 1st of July of 750,000. Now, when you dispose, disposing an equipment means that you sell it. And whenever you dispose, you have two possibilities that you dispose at a profit or you dispose at a what? At a loss. The first thing to work out is how much is the disposal profit or what? Profit or loss. So I'll come down here and I will say that working 2. So how much is our disposal profit? Disposal profit or what? Or loss. Remember that to determine disposal profit or loss, you compare 2 things. Number 1, at the time you disposed it, what is the net book value of the asset disposed? Compare that with what? Compare that with the cash. What is the cash from what is the cash from disposal? All right, so at the time we disposed it, what was the asset's net book value? Now note number 2 says that the asset was disposed for 1,750,000, meaning that the cash from disposal was this 1,750. The cash from disposal was 1,750. What about the net book value for it? The equipment we are told at a cost of 3,750, and the accumulated depreciation on it was 750,000. So if the cost is 3,750 and the depreciation on it we have just 750, the net book value is the difference. So that is 750 minus 750, that is 3 million. So 3,000. 3,000, the difference, that's the disposal what? Profit or loss. Let's agree that the difference is the book value 3 million and the cash of 1,750, that's about 1,250. Is this a disposal profit or is it a disposal disposal what? Loss. Which is which? When the book
Disposal
value
loss.
is 3 million and cash from disposal is 1,750,000, is it a disposal
Loss.
profit or loss?
Disposal loss.
That's a disposal loss. So that's a disposal loss. So that's a disposal what? Loss. So not here that this is a disposal. So this is a disposal. So this is a disposal. This is a disposal what? Loss.
Loss.
Now let's agree. Under International Accounting Standard number 1, yeah. So if this is a loss, remember that this is an expense. You know, normally when you have an income, when you have a disposal profit, that's an income. But when you have a disposal loss, now that's an expenditure. One of the most important provisions of International Accounting Standard number 1 is that expenses classified. Is that expenses are classified by function. Is that expenses are classified by what? By function. For this reason, IS1 says that we have only 4 expense. We have only 4 expense, now categories. So categories. When then we determine an expenditure, like now this disposal loss, under which of the 4 expense categories now does it go to? Which 4 expense categories do we have under International Accounting Standard number 1? The first category is normally which one? Cost of sales. Followed by the category, the administration, the admin. You know, then followed by the selling and distribution. And then the last one is which one? The finance cost. The finance cost. The finance cost is basically interest. The finance cost is mostly interest. So what IS1 insists on is that any expenditure that you have under International Accounting Standard number 1, can you put that under one of these 4 categories? Any expenditure to do with, you know, this was disposal profit or loss. This was disposal profit or loss on what? This was disposal profit or loss on plant. Any expenditure on plant falls under cost of what? Sales. So any expenditure on plant falls under what? Cost of sales. So we shall therefore classify that disposal loss under cost of what? Cost of sales. Let's look at working 3. Let's look at working what? 3. Let's come to note number 3. So let's come to note number what? Note number 3. Note number 3 tells us what? Note number 3 tells us that the company classifies depreciation on plant and equipment as cost of sales. I've already said that all expenses on plant and equipment you classify under cost of what? Sales. And then on land and buildings as admin. These are things that you should know as admin. Depreciation rates, we are told, are then as follows. Buildings, we have straight line over 50 years. And then plant and equipment, we have 20% on reducing what? Now balance. Let me come down here and say that working 3, we now have depreciation. We now have depreciation expense. We now have depreciation expense, depreciation expense. We need depreciation expense on two things. One is on buildings. One is on buildings. Number two, on plant. Number two is on plant and what? On plant and equipment. On plant and equipment. On plant and equipment. Let's start with depreciation on buildings. Now, the one on buildings we are told should be on straight line over what? 50 years. What is the value of buildings alone? Let's do this. If I come back to the trial balance, the land and buildings were together. But please remember, you don't depreciate land. The only asset you depreciate there is the building. Land does not depreciate. Land always appreciates in value, so you don't depreciate what? Land. How much is the value for the buildings? For that reason, you know, the value of buildings will be 210,000. This minus, you know, land alone is only 1 million. So minus that. The rest is the value of what? Buildings. So I'll come here and say that this equals what? This equals, I'll bracket this thing. I'll bracket this because I want to get a difference first before I divide by the 50 years. So I'll have this 210, this one, minus 1,000. Please don't forget that these figures here are in thousands, whereas this one is a full figure. So minus just 1,000. Then I close the bracket. So then I close the bracket. Then I close the bracket. Then I close the bracket. Now this I divide. This I divide by how long? That I divide by the useful life, which is 50 years. So I divide by 50. I divide by 50. That gives me about 41 what? 4180. We have said clearly that because this is an expenditure, it falls under the category that we call the admin. All expenses on land and buildings, they fall under the administration what? Now, category. They fall under the administration category. They fall under the administration category. They fall under the administration category. Stacy, what is wrong with your internet? I've been admitting you for this is now over 10 times now, eh? Stacy, I've been admitting you so many times. What's happening with your internet? I've been admitting you so many times. Yeah, so expenses on buildings. Expenses on buildings. Expenses on buildings, you put under the administration what category? So that depreciation on buildings now goes to the administration category. What about the depreciation on plant and equipment? Plant and equipment, we are told that should be 20% on reducing balance. Reducing balance means that you multiply that 20% by the net book value of the asset. By the net book value of the what? Of the asset. So how do we compute this one? This one equals 20% times, I'll bracket this, 20% times in bracket what? Let's agree. 20% times in bracket, because we multiply by net book value. I take the cost, which is this. So I take the cost of plant and equipment, which is that 64.5, because I'm looking for net book value first, minus accumulated depreciation to year start is this 31.5. That 31.5. Listen to this next thing is very important. Don't forget, don't forget that there was this plant that we disposed. The moment you dispose it, you cannot compute depreciation on it. So you must minus also the net book value of the plant we disposed. So minus this 3,000. Minus what we disposed minus the net book value of what we disposed. I close the bracket and then I can press enter. That gives us a 6,000 what? Shillings. Expenses on plant and equipment. These ones you take to cost of what? Sales. So that will go to the cost of what? Sales. Let's look at note number 4. And what are we told in note number 4? In note number 4, we are told that, let's come to note number 4, which is this. We are told that on 30th June 2023, the company revalued land and buildings to 190 what? 90 million. That including 2.5 million for the land. Now the company follows the revaluation model of I-16 for its land and buildings, but no revaluations had been carried out. The company wishes to treat the revaluation surplus as being realized on disposal of what? Now the asset. In note number 4, we have this revaluation thing. And you know, to revalue simply means that you give the asset a new value. When you give the asset a new value, you have two possibilities, that either you increase the asset in value or you decrease it, If that is the case, ladies and gentlemen, what we need to determine is the increase or decrease in value of the asset upon now that revaluation. So down here is working for, let's look at revaluation. Let's look at revaluation. Let's look at revaluation of land and buildings. Revaluation of land and what? Buildings. When you revalue an asset, you give it a new value. So how much is the new value? How much is the new value? So that's what we are told about in this note number what? Note number 4. So both the land and buildings were given a new value of 190 what? 190 million. So they are total new. Their total new value, we have 190,000. Now, before evaluation, what was their book value? Before evaluation, what was their book what? Book value. What was their book value? Now, book value you compute from the values in the trial balance. So book value should be, I go back to the trial balance. The land and buildings, their total cost was this 210. That was 200 and what? 10. Remember, minus accumulated depreciation to the period start was this 30. But that is not all. Please remember, that's the accumulated depreciation to period start. You have to remember that as per this working 3, we again computed depreciation of this 4180. So further minus 4180. The revaluation happened at period end. And what that means is very simple. The book value at period end is the original cost minus the accumulated depreciation to period start, and then minus this depreciation expense, remember, for the year. And this gives us how much book value? About 175, 820. Note that the difference is what we are looking for. So 190 minus 175, that's about 14,180. Is the 14,180 a revaluation surplus or a revaluation deficit? Because the increase or decrease in value is a surplus or a deficit. Which is which? Is it a revaluation surplus or is it a revaluation deficit? Now that the new value is more, is that surplus or is it deficit?
Surplus.
That's a surplus. Thank you very much. So that's a surplus. So we'll just note that this is a revaluation what? That this is a revaluation now surplus. So that's a revaluation what? Surplus. So later on, revaluation surpluses are treated as part of what we call other comprehensive. If you remember your FR, revaluation surpluses or deficits are treated as part of the other comprehensive what? Incomes. So this will be part of the other comprehensive incomes to then include in our P&L. That's why we are computing now this thing. All right. The next working should be about note number, let's look at note number 5. Let's look at note number 5. Now, note number 7 says that expected credit loss. The question is clear that treat that as an admin expense is on average 10% of the trade what? Receivables. Now, I don't like that terminology because when we talk of expected credit loss, commonly abbreviated as ECL, this is normally international financial reporting standard. It's normally IFRS 9. Expected credit loss is normally IFRS 9. It's a very complicated standard, really. It's a very complicated standard, really. And when you look at the provisions of international financial reporting standards, if you want to compute the expected credit loss, it's a product of a number of things. So that you normally need to multiply 4 things actually. One is what we call probability of default, PD, multiplied by LGD, loss given default, multiplied by EAD. EAD is exposure at default. So probability of default times loss given default times exposure at default, and then times, because this is normally a future value, you must discount it by multiplying by the present value interest factor. This is not what really is given here. They've made it very simplistic that the ECL is on average 10%. So that what they are giving here is more or less like what? What they are giving here is more or less like what we are used to calling the provision for what? For bad debts. So They should have just talked about provision for bad debts being the 10%. Otherwise, when you talk of expected credit loss, when you look at IFRS 9, that's how you compute that thing. But in this case, they are referring to the provision for the bad debts, which they are then coloring by giving that flowery language of expected credit what? Loss. So what we'll need to compute down here, number 5, what we'll need to compute down here, number 5 will be the provision. Let's call it the provision. Let's call it provision for ECL, same as provision for the bad debts. Provision for ECL, same as the provision for the bad what? Bad debts. Now this should equal 10%. 10% times what? The trade receivables. The trade receivables, you know, you have to go back to the trial balance. Where were the trade or the accounts receivables? 10% times trade receivables, they are here, 130. The trade receivables were 130. So that provision for the bad debts, this amounts to about 13 what? 13 million. So that amounts to about 13 million. Please remember, the question is clear that this is an expenditure and this expenditure falls under the admin. The question has said that. So you'll take that to the administration what? Category. You'll take that to the administration category. You'll take that to the administration category. That was very clear here. So you'll take that to the administration category. Let's look at working number 6. Let's look at note number 6. Note number 6, and what are we told here? That the income tax charge, which comprises current and deferred, for the year this is estimated at 11,200 and what? 250,000. We are told of which 4.2 million relates to future payable tax on the revaluation of land and buildings, which should be charged to other comprehensive what? Comprehensive income. So that, ladies and gentlemen, this is the thing. Note number 6 is talking about income tax now charge. Note number 6 is talking about income tax charge. And in this case, I'll be concerned with how much do we take to the P and what? The P and L. So how much income tax charge should we take to the P and what? P and L. The question says that the total current tax plus the deferred tax, the two taxes combined. The question says that we have what? 11,250. 11,250. So that ideally, that is what should go to the P&L. Now, please remember that income tax is normally governed by, this is governed by International Accounting Standard number 12. When you look at the provisions of ICE 12, we talk about income what? Tax. And normally, the income tax comprises two taxes. One is what is the current taxation. Number 2, how much is the deferred? And the thing is, we should have the two taxes separately. But fortunately, this question has already combined them for us, because normally you determine them separately, then combine. So we are fortunate that we have the combined already. The only problem we have is this. Out of this 11,250, we are told of which in this 11,250, we have 4,250, which relates to the future payable tax on revaluation of land and what? Land and buildings. Listen to this. If the 4,250 is the future payable, you know we can't expense it in the P&L for the current year. You cannot expense in the current year's P&L a future expenditure. Look here, look here. The 4,250 we are told relates to what? Relates to future payable tax on revaluation of land and buildings. Now, where did we see this revaluation thing? The revaluation is here. And you know we computed a revaluation surplus of 14,180. Revaluation, remember, is more or less like what? Revaluation, or rather a revaluation surplus is similar to a revaluation what? Gain. A revaluation surplus is similar to a revaluation what? Gain. A gain is an income, which normally you tax. When then you have such a revaluation surplus, you must what? Tax it, even though this is a future what? Tax. So a future tax, you can only provide for it today, but you can't expense it, remember, today. What happens is this. With this revaluation surplus, what should we debit? The debit should be, you know, a revaluation surplus means you have increased the asset in value. So we should debit land and what? Buildings with a surplus of how much? This 14,180. Where should the credit be? Where should the credit what be? There will be two credits. And which two credits are these? One, there will be the credit in deferred. Any tax you are told is a future tax, is a deferred tax. There will be a credit in the deferred tax account. And please listen to this. The credit that goes to the deferred tax account should be the reported surplus times, you know, tax rate is 30%, times tax rate, which is 30 what? 30%. I'm assuming it is 30%. So that what should go to the deferred tax account should actually be this 14 now times what? 30%. That should be about 4250 what? 54. The other credit, which is now the balance. The other credit, which is now the balance, is what we take to revaluation what? Is what we take to revaluation reserve account. And that balance should ideally be this 14 minus this taxation of 42 what? 4250. So the journal entry that should be passed for this revaluation surplus, appreciate, is then this entry here. So when the question talks of the future payable tax because of the surplus, this is what the question is talking about, this 4254. But you know, the question gives us a different figure. How much has the question given us? The question has told us this thing should be 4250. I don't know what tax rate they've applied, but if we work with 30%, it should be 4254. Not far from the 4250 which they've given us. And ladies and gentlemen, what happens is, if that 4250 is a future tax, you know, I've said we cannot take it to the P&L for the current year. And so you must minus it from here so that the tax charge to P&L, the tax charge to the P&L should be the difference after you have removed the 42 what? 4250. Let me make it a negative. So the tax charge is then the difference, which is now, you know, this 11,250 minus this 42 what? 4250. Actually, this is this should be a plus, not a minus. So you just now add them. Add them. That comes to about 7,000. So the only tax charge that you take to the P&L is therefore 7,000. So this 4250, remember, is the future one that you cannot take to the P&L for the current year. Current year's taxation for the P&L is therefore how much? Now this 7,000. Let's look at note number 7. Note number 7. We are told that on 1st of January 2023, 𝗪𝗏𝐺 Limited made a 1-for-4 bonus issue, capitalizing the general reserve. To capitalize means you reduce the general reserve. You know, a bonus issue is giving existing shareholders shares for free. A bonus issue is giving existing shareholders shares for what? For free. So the company must finance the bonus issue. It finances by utilizing one of the reserves that it has before the bonus issue. So in this case, they decided to use the general reserve to finance the bonus issue. The question says that this transaction had not been accounted for. The fair value of the company's shares on the date of the bonus issue was 37.50 shillings per what? Per share. Working number 7 is about what is the value of the bonus what? Bonus issue. So bonus issue value. What is the value of this bonus issue? Now, please remember that a bonus issue is normally valued at what value? Per value. Normally valued at par value. If I want to compute my bonus issue, I say that this equals what? You know, we are told we have a 1-for-4 bonus what? 1-for-4 bonus issue. That means that you have 1/4. 1/4 means that you have 1/4 of the ordinary share capital. So you multiply this thing by the ordinary what? Ordinary share capital. Ordinary share capital, we have this 25,000. Please remember, the ordinary share capital is normally at par value. If the bonus issue is also valued at par, then the value of the bonus issue is therefore 1/4 of the ordinary share capital. The bonus issue is valued at what? 6250. How do we account for this thing? We shall debit. You know, we've said we utilize. We have said we utilize the general reserve. So decrease general reserve by debiting that general reserve. Reserves are credits. To then decrease them, you debit them. Correspondingly, what do we credit? We credit the ordinary. We credit the ordinary share what? Share capital. With any issue of shares, you must increase your ordinary what? Share capital. That is the accounting entry for that thing. So reduce general reserve and then increase the ordinary what? Now share capital. Let's look at the next note. Note number 8. By the way, you don't need this statement here in valuing a bonus what issue. It is shown to you to confuse you. When you are told of the fair value of shares, you know that is the market value of shares. Do you need market value when valuing a bonus issue? Remember, no. Bonus issues, you value them at what? Par. So even if you are given that market value of shares or the fair value, you don't need that thing. Let's look at note number 8. We are told that 𝗪𝐸 Limited uses the fair value model of IS40. IS40 is about something we call investment property. So 𝗪𝐸 Limited uses the fair value model of IS40. We are told that the fair value of the investment property as at 30th June 2023 was 147 million. So ladies and gentlemen, what IS40 require, what this standard require is that when you have investment property, at every date you report, adjust their values to what we call fair value. Adjusting their fair values to fair value is the same as you revalue them to their fair value. If the fair value is this 147, then you adjust their book value to this 147. Just like revaluation, there are two possibilities here, that either you increase the asset in value or you decrease the asset in value. If we are adjusting their value to this 147, are we increasing or decreasing this asset in value? This is what we'll do. I'll come back to my trial balance. Let's look at the trial balance. Where were the investment property? They are here. This row 16. Their book value was 137 million. At the date we report, their value, we now have 147. We have therefore revalued them from 137 to 147. We are increasing them in value. Working number 8. Working number 8, we have increase. We have increase on fair value adjustment. This thing is more or less like revaluation, but don't call it revaluation. This one we call it fair value adjustment. Revaluation is on PPA. Remember, as per IS16, fair value adjustment is on the investment property under IS40. And so the increase is equal to 147 million, their new value, minus their book value is 137. So that that increase on fair value adjustment comes to about, that is 10,000. That's about 10,000. So that's about 10,000. And just like revaluation surplus, this thing is treated as part of the other comprehensive incomes. So that thing is treated as part of the other comprehensive incomes. So that thing is treated as part of the other comprehensive, incomes. And so, ladies and gentlemen, for me, those are the important workings that we needed to have before we can proceed to prepare the financial statements. That is what the question wanted. And so at this very moment, unless somebody has a question, then we'll proceed on to now prepare the required financial reports. Is anybody having any question on those workings before we can then prepare the financial statements? Please ask your questions before I proceed to the financial reports. The financial reports depend on these workings. And so if you have any question, ask it first. Nani yako na swali kwanza kabla hatujaendelea? Yes, Purity.
I got a bit lost at number 6, the calculation of 7,000.
The 7,000 I've computed as simple as, do you know where the 11 to 50 has come from? You are told here, not number 6, that the income tax charge, current and deferred, for the current year is estimated at this 11,250. So the total for the current and deferred taxes is 11,250. In bracket, you are told that out of this, of which 4,250 relates to future payable what? Tax. You know, ideally, the tax is an expenditure that should go to the P&L, so that if the total is this 11,250, that should go to the P&L. But we are saying this, because 4,250 is a future tax, that's a future tax, we cannot expense it in the current year's P&L. We don't do that. So what do? We remove it from this 11,250. If I remove 4,250, I remain with how much? 7,000. Purity, is that okay? All right. Nani yako na swali lingine? Swali lingine? Okay. Let's look at the first financial report. And the year ends on 30th June 2023. The name of the company, 𝗪𝗪𝐶𝐸. You must start with the title, remember. So this is now part A. The title is 𝗪𝗪𝐶𝐸 Limited. The report we are preparing is the statement of profit or loss and other. Let's just call it the statement of comprehensive. Just the way the question puts it, the statement of profit or loss and other comprehensive incomes for the year to 30th June. This is 2023. So you must start with a title. You must start with a what? With a title. Let me have the currency here. I'll work with only one column for the amount. And also, as you do these things, also work with just one column. Just one column for the amount. In an income statement, we do start with what? Now, it's obvious that we start with the sales revenue, and revenue was actually the first item in this trial balance. So I just copy that one. I copy that one plus the amount for it. So I copy that one plus the amount for it. I copy that one plus the amount for it. So 662,000. Hiyo haina maneno mingi. That one you very simply copy. Hiyo haina maneno mingi. So you very simply what? Copy. The revenue is normally followed by what? After revenue, we do proceed on to the cost of sales. The cost of what? Sales. The cost of sales. Now, ladies and gentlemen, sikiliza kwa makini, listen to this very carefully. Under International Accounting Standard number 1, you don't show in your P&L the components of the cost of what? Sales. You calculate one cost of sales, and that's what you present here. If you come here and start writing opening stock purchases, ukiseparate, you will get a 0. You will get a 0. The rule under ISO 1 is that here, bring in the adjusted cost of sales what? Figure, which now let's compute. How do we compute this thing? The cost of sales is normally opening stock plus purchases first. Come back to the trial balance. The opening stock, we had what? The opening inventory, we have this 111. So I take that plus the purchases figure is this 417. 417. Remember minus closing stock. The closing stock is in working 1. This working number 1, I minus this 95 to 50. Don't list those things down there. In the income statement, you take only one figure. But please also remember, you have adjustments for the cost of what? Sales. In these workings, severally, we said that some expenditures are also part of the cost of what? Sales. So that plus, a very good example is this disposal loss. So you say plus that disposal loss, again plus this depreciation on plant and equipment, plus this also. Did we have another one down here? Hapana, hakuna ingine. So just plus those two, the cost of sales, therefore comes to what figure? 440,000. So what you should show me in this statement is 440. I don't want to see anything else. So don't come here and start listing things. You will be going against the rules of IS 1. You bring here the summarized what figure. Now you can leave it this way and then just minus, but I like that you put this in bracket. I like that you put this 440 in what? In bracket. What I can do is to just minus, then in the bracket, the whole of this thing. I like that that is put in bracket so that it shows as minus 440. Minus 440. With that, we can compute our gross profit. We can compute our gross what? Gross profit. Gross profit, I'll simply add these two. So that comes to 222. So that comes to about 220 what? 22. Now, before you can minus the operating expenses, add to the gross profit the other operating incomes. Add to the gross profit the other operating what? Incomes. So you add to the gross profit the other operating what? Operating income. So add to the gross profit the other operating what? Incomes. The other operating incomes include which ones? I'll say that equal to, remember, not other comprehensive. I'm talking about other operating. In the workings, I have other comprehensive. Those ones you don't add to the gross profit. The other operating incomes, you'll come back to the trial balance. In the trial balance, I have seen one. We have this rental income. So we have this rental income. So I'll click on this 12,000. Down there, don't present it as rental income. Just say that other operating incomes. Then if you have many, add all of them together and present one figure down there. So that comes to that 12,000. If that is it, then we can add the two downwards to get the total operating income. At this point, we can minus our operating expenses, which include which ones? The operating expenses are included. One is this distribution cost, and then admin. Actually, look here. You know, we said that under IS1, expenses are classified into 4 categories. The cost of sales, tumemalizana naye. Then that means we have only 3 other expenses: admin, the selling and distribution, and then the finance what? Cost. Selling is normally together with distribution, selling and distribution. So the last one should be finance what? Finance. The last one should be finance cost. So ladies and gentlemen, remember that you cannot have another expenditure outside these categories. You can't have another one. The distribution cost, we pick it the way it is because in the workings, we did not say anywhere that adjust distribution. So distribution will equal negative distribution expense is this 128. So minus 128 minus 120 what? 128. Distribution, yes, 128. What about admin? Admin will equal what? Equal to, in the trial balance, admin is this 86.5. Admin is 86 what? 5. Admin is 86,000. Now 500. 86,000. Now 500. But we need to adjust it, remember. So this is plus. Admin is plus this depreciation expense on buildings, this 4180. So that 4180. Which other admin do we have? Plus again, the other admin is this provision for ECL, working number 5. Provision for ECL, so working number what? 5. The admin comes to a total of 103, now 680. But again, I want to put that in bracket. So equal to minus, I bracket the whole of this. So admin is 103,680. The finance cost. The finance cost is interest. The finance cost is interest. And so what we do is to go back to the trial balance and check on which loan do we have. The loan which we have is, you know, we have this 8% loan, 8% loan stock. The loan was 37,500. So we need the interest on it, 8% of this 37.5. So I'll come down here and say that this equals, the loan is 37.5 times the interest rate on it is 8%. 37.5 times 8 what? 8%. To make it a minus, I'll just put minus before any one of those things. And the interest on loan, we have 3,000 shillings. The interest on that loan, we then have 3,000 what? 3,000 shillings. So we then have 3,000 what? Shillings. So that is it. And so I add them downwards to get my, so it's a minus. It's a minus, it's a minus. If it is a minus, it is a loss. We then have loss before what? Before tax. We are then having a loss before tax. So that is a loss before taxation. At this point, we introduce the income tax. Income tax expenditure. So how much is the income tax expenditure? So income tax, we had computed this one also. In this working number 6, we said that the tax charged to the P&L is only 7,000, yeah? So equal to negative this 7,000. So that our loss after tax, the loss after tax is therefore 76 what? 7680. The loss after what? Tax. So at that point of profit or loss after tax, you then introduce the other comprehensive, incomes, which by the way, you'll make bold and underline. At that point, you then introduce the other comprehensive what? Incomes. Now, which other comprehensive incomes do we have? The first one is the revaluation what? The first one is the revaluation. The first one is the revaluation surplus for the year. The first one is the revaluation surplus for the year. The revaluation surplus for the year, we computed what figure? We computed this 14,180. This one in working number 4. So we calculated that 14,180. 14,180. You have to remember that this surplus attracted some taxation, and so you must reduce the surplus by tax. The surplus was taxed, and so you must reduce the surplus by tax. So let me talk of deferred. Let me talk of deferred tax effect on the surplus. Deferred tax effect on the surplus. The tax is the tax equals, the tax is a minus. The tax is a minus, so this minus 4250. That tax that the question gave us, 4250. That tax that the question gave us, 4250. The tax, this is the tax on this surplus or gain. So you reduce the gain by the tax on it. The other comprehensive income is which one? We also had increase on fair value adjustment. So we also had increase on fair value adjustment. The increase is also more or less like a gain, so that's a plus. This one you don't tax. You only tax revaluation. Fair value adjustments, you don't tax them. And if that is the case, we are done. Let's now compute our total what? The total comprehensive income. The total comprehensive income, you add from the loss after taxation. You add from the loss after taxation, and that's it. And so that is it for the income statement, which is number 1. Nani yako na swali on this income statement? Any question on this income statement? Yes. The what? The loan stock. Lucy, what is your question about the loan stock?
The 1.5 that was reported in the TP, what does it mean?
Now, remember, the full interest on this loan is this 3 million, what we have computed here. 8% of the whole loan stock. This one in the trial balance, this is what you are talking about, is what has been paid. So you are told here that interest on loan stock paid is this. So the interest expenses are 3 million. Out of 3 million, what they have paid is just 1.5 million. The other 1.5 million that they've not paid will be a current liability as we then prepare the balance sheet. Sawa sawa, Lucy. Swali lingine? No other question. Let's look at the second statement. Part B. Again, you have to start with the title. Don't forget that. 𝗪𝗕𝐶𝐺 Limited. And this is now the statement of changes. The statement of changes in equity. We say that for the period 2, the year ends on 30th June, now 2020 what? 23. And ladies and gentlemen, you know, once you are through with this course and you become ISPAC members, you'll now have the power to do audited accounts. This is still how audited accounts are done. So you are not learning this just for exam. You are learning this even for practice. So that as you do audited accounts, you'll first do them in Excel. You first do them in Excel before you can print, stamp, and sign them as somebody with authority to do so. So we are learning this not only for exams, but also for practice. This is how audited accounts are done. If you are not going to be an auditor, you just want to be an accountant somewhere, again, you'll be told within the entity that can you do internal accounts called the management accounts. Again, the management accounts will have this very format. This same format. So we are learning this for practice also. All right. For the statement of changes in equity, you know, this one shows the items of equity and the changes on them during the year. The first thing to do is to identify which items of equity we do have. The most obvious item of equity is the ordinary share capital. So you will always arrange them in columns, starting with ordinary. So starting with ordinary shares. Now this we shall follow with related to the ordinary shares is the share premium. Those two go together. Apart from this, what other items of equity do we have here? Let me see. There was ordinary shares, there was share premium, there was retained earnings. So I'll come down here. Another column is retained Another column is retained earnings. Another column is retained earnings. Another column is retained earnings. Which one also? Apart from these three, there was, down here, there was general reserve. Down there was general. There was also general reserve. General reserve. Now, in the trial balance, I don't think that, do we have another one really? In the trial balance, we don't have another one. We don't have another one. But in the workings, we've seen that we have revaluation reserve. We've seen that whenever you have revaluation, then there arises the revaluation what? Reserve. And apart from revaluation reserve, there is still one more. You know, there was also the fair value adjustment. There was also the fair value adjustment what? Reserve. And then assuming that this is all, assuming that that's all, there will be a total column. So total. So that's what you do first. For each of these things, you will start with what are their balances what? Brought forward. And even before that, let's just have the currency. I like that we first have the currency before the figures, so that this was shillings in thousands. Same for the share premium and all of them to the total. So shillings in thousands. And so you start with the balance brought forward. Let me make your work easy by saying that the balance brought forward are normally from trial balance, from TB. Get the balances as per the trial balance. Ordinary shares, for example, was how much? In the trial balance, this was ordinary share capital, 25,000. The share premium was 61,000. The retained earnings was 188 to 50. General reserve, the general reserve was 142,500. Please note that these other ones, we did not have them in the trial balance. So 0, 0. Those other ones we didn't have. So 0, 0. And then of course you add them across. If you add them across, that is 416,750. The total for all, the total for all, the total for all, the total for all. Now, this is followed by what? This is a statement of changes in equity. Your focus should be on what are the changes on these things this year. Your focus should be on what are the changes on these things now this year. What can make the ordinary share capital change? The ordinary shares and the share premium will change only when you have one thing. What is this? If you have issue of shares. Like in this question, remember, which issue of shares do we have? There was a bonus issue. The bonus issue increases the ordinary what? shares. So you increase ordinary shares, you add for the ordinary shares, the bonus issue was this working 7, the value was 6250. So you increase ordinary shares by that 6250. We said that the bonus issue is financed by capitalizing the general reserve. I said to capitalize a reserve is to utilize it. Utilize it meaning that reduce it. When you utilize a reserve, you reduce the reserve. So you'll have the same figure as a minus under the general what? Reserve. We have 0 for these other ones. So we have 0 for these other ones. So in the same manner, we compute total. So you realize that the total here is 0 because it's a plus a minus. They cancel. So you have a 0. The bonus issue does not affect share premium. The next item that therefore changes is the retained earnings. The retained earnings must change by 2 things. You know, one, you've prepared the P&L. And for the period, you know, we had this loss after tax. This is loss after tax for the period. That is what comes here. So let's introduce the loss after tax for the period. In case you have a profit, then you introduce the profit after tax for the period. This does not affect the ordinary shares. Neither does it affect share premium. Retained earnings, the loss of this 76.80. It does not affect the general reserve, does not affect all these others. And so again, we compute the total. All right. What also adjusts the retained earnings? The retained earnings is also adjusted by what? By dividends. The retained profit is also adjusted by what? By dividends. Dividends reduce profits. So that when you have dividends, you minus from profit. So this equals what? The dividends was somewhere in the trial balance. So equal to negative, I go back to the trial balance. The dividends was somewhere, they were here. This row 22, dividends paid 6,500. So dividends paid was 6,000 what? 500. So dividends paid was 6,000, now 500. So this does not affect the others again. And so I get the total. So the general reserve we've seen on the change on it. Next is the revaluation reserve. For the revaluation reserve, remember we have the revaluation surplus for the year. The revaluation surplus for the year is what you adjust under the revaluation reserve. So that 14,180, I just copy it from the P&L. 14,180. The revaluation reserve we said is reduced by the deferred tax effect on the surplus. You must reduce the revaluation reserve by the deferred tax effect on the what? On the surplus. So that we'll have that negative 4250. So 0. The total is that. So lastly, the fair value adjustment reserve has the increase on fair value adjustment. So that under the fair value adjustment reserve, we have that 10,000. If that is the case, again, the total, and that's it. That's it. So that is it for the statement of changes in equity. That is it for the statement of changes in equity. That's it for the statement of changes in what? In equity. So these are therefore the balances carried what? Carried forward. Very simply, I add them downwards. So this equals the sum of all this. Then of course I just drag the formula, the total. So that's it for my statement of changes in equity. Any question on the statement of changes in equity? Nani ako na swali? Any question? All right, lastly, we can look at the balance sheet. Part C. So again, you must start with the title, 𝗬𝐵𝐶 Limited. This is now the statement of changes. Not statement of changes. This is now the statement of financial. The balance sheet is nowadays called the statement of financial position. So the statement of financial position, which you don't prepare for the period two like the other two statements. Balance sheet you prepare is at. This is 30th June. The year is 2023. The balance sheet you prepare is at. And so I'll have the shillings in thousands. In a balance sheet, we do start with the non-current assets. The non-current, the long-term assets. So we do start with the long-term assets. Which non-current assets do we have? Now, the first one is normally items of PPE. And once again, this is very important. IAS number 1 does not allow that you go to the balance sheet and then ati unasema land and buildings peke yao, land and equipment peke yao. IAS 1 does not allow that. That's not allowed. So that's not allowed. If that is not allowed, you must always combine all of them and present them as one thing in the name PPE. So that the PPE comprises one, we have land and buildings, and then we have plant and equipment. So we need the values for the two combined. Let me start with land and buildings. The land and buildings were revalued at the end of the year. By the way, when you revalue an asset, post the revaluation, you work with the new value. You forget about the old values, you work with the what? With the new value. So if land and buildings were revalued, then we work with the new value, which is how much? In this working number 4, that's where we had revaluation. New value for the land and buildings is this 190. So 190,000. 190,000. Forget about anything before that revaluation date. What about plant and equipment? For the plant and equipment, they were not revalued. So we start from the trial balance. For the plant and equipment, you start from the trial balance. In the trial balance, their cost was 64.5. Remember minus. At the start of the year, we had revalued, we had depreciated, by this 31.5. So we had depreciated by 31 what? 31.5. But you have more adjustments, remember. In the workings, minus. You minus, first of all, the disposal. Minus the net book value of the asset we disposed. So we disposed plant at a net book value of this 3 million. Minus again what? The same plant and equipment were depreciated this year. So you must minus that depreciation for this year. So minus this 6,000. And that's it. And that's it. So that for plant and equipment, that's 24,000. If I add them, they total to how much? This plus this. They total to 214. So that is what comes here, 214. So don't come to this balance sheet and then separate these things. Even if you present the correct values, but separated, you get a 0. Even if the values you are presenting are okay, the fact that you will have separated will mean that you get yourself a what? A 0. Let's go to which other non-current asset do we have? There was another one. There was investment property. The investment properties are long-term what? Long-term assets. The investment property was adjusted to fair value. Remember, you can't work with the trial balance value. As per note number 8, we adjusted this to fair value. Remember, of 147 what? Million. So we work with 147. So we work with 147,000. 147 what? Million. So 147 million. Is there another non-current asset really? I don't think so. If that is the case, let us total them. Total non-current asset will be that summation 361. Let's go to the current assets. Let's go to the current assets. The current assets are, obviously you do start with inventory. Obviously you do start with inventory. Inventory, we determined the value in working 1. If you go back to working 1, we said inventory at the law of cost and NRV, we have this 95 to 50. 95 to 50, the inventory. Now this is followed by the trade. This is followed by the trade receivables. The trade receivables, these ones. The trade receivables. Now the trade receivables equals what? The trade receivables was this 130. The trade receivables was that 130. But I want you to remember this, ladies and gentlemen. On these trade receivables, we made some provision. We provided for some bad debts. we provided for the ECL. So you must minus the provision for ECL or the provision for the bad debt. This working number 5, you must minus this 13 million. So you must minus that provision for ECL, And that will come to about 117,000. Which other current assets do we have? Do we have the financial assets at fair value? Do we have cash bank? Which one do we have? Yes, we have cash and cash equivalents, that one. So we come down here and say that one more current asset is the cash and cash equivalents. The value is how much? Cash and cash equivalents is 8,000. The cash and cash equivalents, we have 8,000. So 8,000. Do we have another current asset? Let me see. I don't see any. So that is it. Let's compute the total assets figure. Total from the non-current would come to about 581,250. So that is the balancing figure. Let's come to equity. So let's come to equity. Now, for equity, there is not much. Having done the statement of changes in equity, there is not much. So that here we'll just have those equity items. I can copy them from the trial balance. I have the ordinary share capital, the other two, and then of course share premium, and then of course the retained earnings, and then of course the general reserve. Those ones I just copy the names first. And then we have said that we have revaluation. We have said we have revaluation surplus. And then lastly, we have said that we have fair value adjustment. We have fair value adjustment reserve. So we have fair value adjustment reserve. So these ones, their values we copy from the statement of changes in equity. Retained earnings is this 31 to 50. The share premium is this 61. The retained earnings is that 174. The general reserve is that 136. The revaluation reserve is 93.30. And this last one is 10. So those ones we just copy from the statement of changes in equity. When I add them, I have the total which I have seen already. That total of 422,500. So those are equity. Equity, you just copy from the statement of changes in equity. So equity, you just copy from the statement of changes in what? Of changes in equity. So the statement of changes in equity. Now this is followed by the non-current. This is followed by the non-current assets. So that is followed by the non-current what? The non-current assets. The non-current assets. So the non-current the non-current assets. So the non-current assets will comprise which ones? One, we have that loan. Loans are always non-current unless you are told otherwise. So the loans are normally non-current unless you are told otherwise. So 8% loan stock. The amount of the loan stock, we have the same amount of 3750. This one which we have here, 37,500, I mean, 37,500. Now followed by which one? Followed by deferred. Followed by deferred. So followed by deferred tax. So followed by deferred what? Deferred tax. Deferred tax, we were told, is a provision of, this is a provision of 42 something, the 4250. So that's a provision of 4250, deferred tax, a provision of 4250, deferred tax. So it's a provision of 4250, deferred what? Deferred tax. And then, yeah, so deferred tax is normally a non-current liability. So this is not how you write deferred. Deferred is single F and then double R. Single F double R, deferred tax. So deferred tax is normally a non-current liability, whereas the current tax is a current liability. Let's look at the current liabilities. We don't have another non-current liability. So current liabilities. So current liabilities. The current liabilities, let's start with the trade payables. And the trade payables were here, these ones, the trade payables. The amount for it is 108. Those ones I'm simply copying. 108,500, followed by which other current liability? The other current liability is current tax. Current tax. The current tax we saw, you know, the total tax was 11 to 50. We removed deferred of 4250. So it's more or less like current remained at 7,000, I mean. So that 7,000 is what comes here. So that equals to 7,000. If the total tax was 11 to 50, and we remove deferred of 4250, then current, we have 7,000. So 7,000. Which other current liability do we have? The other current liability is accrued. We have accrued loan stock, interest. We have accrued loan stock interest. The loan stock we agreed was a 3,000 expenditure. What we have in the P&L, so what we have in the P&L, it was 3,000 expenditure minus what was paid. I already explained this thing from Lucy's question. I already explained this thing. So minus this which was paid. So the balance is then the accrued. The balance is then the accrued. So the balance is the accrued. The balance is the accrued. And so the accrued is 1,500. So the accrued is 1,500. Do we have another current liability? Do we have another current liability? I'm not seeing any. And so we can check on the balancing of this balance sheet. That is it. And so we compute the total equity and liabilities. Total equity and liabilities. So I add all that. Now, ladies and gentlemen, remember, so that balance is at 581 to 50. You know the total assets was 581 to 50. That must also be 581, now 250. Let's agree, ladies and gentlemen. Use one straight line for the amounts. Don't have some amounts on this side, some on this side. Straight line, standard financial reports. Amounts are shown in a straight line. Everything in a straight line. And so that is it for that part C also. Nani ako na swali? Any question? The marks here were distributed as there is no marks for the workings. That's number one. So no marks for the workings. Now for the balance sheet, the marks were awarded as there's no marks for the total. Totals are never marked. So totals are never marked. Yeah, so 1-1 for the two non-current assets. The current assets are also 1-1-1. This is 1-1. So the balance sheet will have a total of, the balance sheet had a total of this summation. So the balance sheet alone had a total of 16. You know, this question had 30 marks. So remember, it had 30 marks, not 20. This one had 30 marks. So the income statement similarly, the marks were awarded as 1 mark for each correct entry. So every correct entry had 1 mark. Yeah, so income statement, that total is about, that's about 10. So 10 plus 16, that's 26. I need 4 more. So in this case, what we did was to count this 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, so you count, oh, that's not what I meant to do. So you count, you count those. For the statement of changes, you count this. They are totaling 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So in that case, any 8 at a half, any 8 at a half, giving you 4 marks. So when you count all that, when you add all that, you end up with, when you add all that, you end up with 30 marks. So that is how the marks for that part were allocated. Purity, is that okay?
Yes, thank you.
All right. Nani ako na swali ingine? Or somebody is saying, did I mess up on some liabilities? Non-current, yeah. So this should be non-current liabilities, not assets. Non-current liabilities, not assets. Not assets. So that is it. That is it to that point. That means that still under financial reporting, we have 2 more important discussions to do. We still have to discuss financial statements. We still have to discuss financial statements forecasting. Financial statements forecasting, and also discuss consolidated. And also discuss consolidated financial statements, consolidation. So with that, we would be done with financial reporting. With that, we would be done with financial reporting. So we have those 2 more discussions before we can call it an area. Before we can call it an area. So these other 2 we will then discuss in our respective classes. We'll discuss in our respective classes. So we'll revert back to our respective classes starting tomorrow. So those we should be meeting this evening. There will be no class this evening. I want you to enjoy the rest of your 𝗪𝗪𝗧𝐺𝐬 day. I hope with the work I'm doing, I'm your 𝗪𝗪𝗧𝐺𝐬. So thank you very much, ladies and gentlemen. I'll be stopping there. Remind me that what should I be sending you? I should be sending you that handout for ratios, and then this Excel, So I think with that, we can call it a day. Enjoy the rest of your holiday, and see you in class from tomorrow. Asanteni.